All right, well, welcome everybody. Welcome to this 5-part IFM series. So you're taking the IFM. So proud of you. Great job. Man, it's not an easy test, right? Super hard test. If you've been using a learning platform, they might have these like 20-page like memorization sheets, formula sheets that you're supposed to have, and man, it's just not easy. So it's like, man, just not easy. But you guys have just like, I'm sure you guys have been studying a lot. Maybe this is your first time taking it, maybe it's not. But hopefully during these seminars you'll see a different way to think about things so that you can really not just like kind of learn how to apply some sort of formula, but my goal is to help you to kind of make sure you really understand why you're doing what you're doing, and at the same time kind of give you like a framework to keep things simple. Because I feel like on this test especially, there's this problem with like kind of given the choice between, well, it's either a call or a put. Okay, and then you try to think through it, but then it's like sort of like this 50-50 shot. Like sometimes you get it right, sometimes you get it wrong, but kind of little things that can help you to get that correct more often. Yeah, that's sort of my goal. And as you look through the different seminars here, you see the types of topics we're going to talk about. There's certain things you want me to focus on, please let me know. This is your seminar, so anything I can do to kind of help you guys out, but that's the rough framework. We'll be going through those slides together, so if you can print them out, or if you haven't printed out, or if you're using your tablet, feel free to write on them. The color one is for your tablets, but the printer friendly one is obviously for your printer. So just whatever is good, but it is kind of good to kind of write through it. It's hard when you're just listening to somebody talk for a whole long time. Like even watching the videos, you're like, oh, I got it while we were doing it, but I just, after that, I tried to do some problems, I couldn't do it. And sometimes it's because you're just kind of like watching, but you really need to write stuff as you go and ask questions. Like that's kind of what this is for. So I got the chat box open. If you have any questions, please feel free to just chat questions to me, or if you want to unmute yourself and answer, or like ask them, totally great too. That'd be awesome. Whatever you feel most comfortable with. If you could, for your name, if you can kind of put your name and maybe like the school that you're at, or maybe the company that you're working for, and maybe the state. I think that might be nice for everybody to see kind of where just everybody's at. And we'll keep the videos off, just so that you can just kind of relax and just enjoy, and just kind of be able to focus on the materials. So, but my name's Dr. Geoff Apel, and it's so nice to be able to help you guys with this. There's only 2 more shots at the IFM, right? So hopefully this will be the one. You can get it, but if not, at least there's still like one more try. But this is a really tough test. So let's see what we can do here. Now, during the seminar, I'll be going through these slides together. If you have questions, please feel free to ask. This will be recorded, so you'll be able to have it for later. And yeah, this is just for you. I'll try to ask questions for you to be a little bit interactive, but it's a little hard over on a seminar. So, but yeah, let's just get to it. And I'll try to point things out. So a little bit about my background. I was a professor for like 10 years, and I learned actuarial science as I went. And then I lived abroad for like 8 years and tutored specifically for these exams. And so I got a real good idea about the kinds of things that students struggle with the most, especially when it comes to like the P, the FM, and the IFM. And so I put these seminars together because these are the things that I found that students kind of like, they sort of knew how to do stuff, but they didn't really know why, and didn't have like a good system. So I kind of developed this to sort of help those out, to target those specific areas, and not to necessarily replace the thing that you've done. Like you've kind of learned, you sort of have your own like techniques for it, but it's not necessarily to replace that, but it's kind of to complement that, so that if you're used to doing things a certain way, that's fine. But kind of seeing it maybe this way too might help you to understand that a little bit better. And you'll see that today when we talk about arbitrage. And I know there's like kind of a certain way that a lot of the platforms do it, but I'll do it just slightly different, but not to replace it, but just to complement it. Okay. So yeah, let's get started. So today we're going to talk about some of the basics here, the fundamental things here, especially with options, forwards, futures. And we'll go through some of these slides pretty quick, and some will take a little bit longer. So the first things here, when it comes to these introductory things, these beginning things, So derivatives, well, first of all, a derivative is not in calculus, the derivative, but derivative because it's something that derives its value from something else. And the ones that we are mainly going to be dealing with are forwards, calls, and puts, obviously. Um, so we kind of want to think of like the definitions. The definitions are important, but we're going to see that we're not going to really want to go back to these very often, the definitions. We're going to actually want to think about them a little different. But the definitions, well, what do they say? Well, the definition, so a forward is a forward contract. If you're long in a forward contract, that's an obligation to buy some asset at the forward price. Actually, that's not very thick, is it? So let's go buy some asset, the underlying asset of the forward price, and the short would be the obligation to sell. So I'm sure those are pretty clear. The thing that the reason why I put this slide here is because, well, a long call is also is now an option to buy, not an obligation, but an option to buy the asset at a certain price. But the thing is that, well, a short call isn't sort of like the parallel to a short contract, a short forward. Actually, the parallel there is that a put, a long put, is sort of the parallel to a short forward because this is going to be an option to sell. Okay, so we're actually going to mainly focus on just almost like this row here, just kind of what a long thing does, because a short will be just the exact opposite of it. And mathematically, that'll just be like the negative. So we're going to handle a short by making it the negative of a long. That's going to kind of simplify our profits and payoffs and our just even our mental baggage that we kind of have to do. Because if you try to use these definitions to think through what's happening, it's too much overhead. I mean, in math, that's kind of what the whole point of math is, to sort of like have some things be simplified for you through the math. You know, like we don't rederive the quadratic formula each time because somebody's already simplified that math for us, and then we just get to use those benefits. So we're going to try to do that here too. Let's find little ways that we can keep things simple for us to sort of like clear our mental faculties here so that we don't have to overload them. Because I don't know about you, but when I tried to do that, when I tried to think through stuff, I always would sort of like go wrong some way. And so if we could find a way to keep that simpler, that's the best. Okay. So that was the definitions, but what we really want to think of is a little bit different. We really want to think of like, well, in terms of the payoff or whatever, what do we want to happen? What do we, they're all based off of some underlying asset. What do we hope happens to that asset for these things to be like productive somehow for us? So for a forward contract, the long forward, they of course want the asset to go up. And so the short then would want the asset to go down. And because these are sort of parallels here, the long call also wants the asset to rise in price. And we remember that because we're like, oh yeah, a call will pay if the stock goes above the strike. So it's going to, oh, we want the price to go up. And a put really wants the price to go down because the put will pay if the price is below the strike. Now, it's such a simple thing, but we're going to really want to, like, this is kind of how we're going to want to think of it. Like, oh yeah, a put wants the price to go down, a call wants the price to go up, and a forward contract, well, if it's long, it really wants the price to go up. And we're going to mainly focus on these things because it's not really appropriate down here for a short call to say that they want the price to go down. I mean, it's kind of true, but like if you're short in a call, you don't have any rights at all, right? You have sold the rights to exercise the call to someone else. So you don't get the like ability to hope for anything there. It's like the ball is completely in the other person's court. It's all up to them as to like as to what happens. Now, of course, you would love for the price to stay low because then it doesn't pay. So it's true kind of, but really when you write a call to someone else, you give away that ability to like dictate what happens in a way. So so we're going to kind of stick to everything sort of being a long, kind of thinking in terms of what the long would like to do. In fact, what we're going to do is we're going to simplify things totally. And I think some of the books and study resources, they do this, but they don't really say it explicitly. But what we're going to do is anytime we have a portfolio, which is a combination of calls and puts and stocks and shorts and bonds and forwards and stuff like that. So for us, anytime we have a combination of things, not just a single item, but a bunch of them, we call it a portfolio. And what we're going to do is we're going to kind of write an equation almost with it. And for portfolio, anytime I use a plus, we're going to mean that we're long in it. And anytime we use a minus, we're going to be short. Now that's going to be beautiful for us because then that's going to be kind of like back here. We don't even really need to think about this row anymore because it's already thought about for us with that negative, because everything with the short is going to be just negative of what happens with the long. But the beautiful part about this is it's going to simplify things so nice because that means that the cost will follow the same exact pattern, minus or plus for long, minus for short. And the payoff follows exactly the same sign pattern, plus for long, minus for short. Now, so here's one place where it might differ possibly from what you've done before, or there might be some sort of problem if you're not aware of this. But cost is sometimes seen a little different. In fact, if it costs me $10, so if the cost is a positive 10, what does that mean? Well, I had to pay $10. That would be, what would that be for my cash flows, positive or negative? Well, it'd be negative, right? It's a negative cash flow is a positive cost. Okay, so for us, we're gonna just kind of keep in the back of our minds that if it's all ever about cost, cost is great because it follows the same sign pattern as what we see here. So it's beautiful, it's one less thing to think about. But we just kind of want to keep that in the back of our minds that it's actually a negative cash flow. So just keep that in mind. It's not a big deal, but just sometimes like some of the other platforms, they might kind of do things in terms of cash flows. And we're going to see that when it comes to arbitrage, but they kind of do things in terms of cash flows. So they might do things sort of the negative of what we do. But again, it's not meant to confuse you, but it's meant to sort of complement maybe how you understand it. So you say like, oh, they're saying cash flow. Oh, okay, got it. That would just be negative for cost or whatever, but you're flexible. You could do it either way. Okay. Now let's see why this is actually how this benefits us. Okay. But it's super simple, right? So portfolio, cost, payoff, they all have the same sign pattern and everything. And then the profit, well, we're probably familiar with this too, that it's just the payoff minus the future value of the cost. And by the way, minus the cost. So that would be like this whole kind of thing. You could also add the the present value of the cash flows. So you could kind of, maybe you've seen it like that too. But yeah, it's okay. Just as long as we're aware of it, but that's kind of where it comes up. We see things like that. So let's put this into practice here for our first example. Okay. And again, any questions, please feel free to just chat them or whatever, no problems. So our first example here. So an investor writes 3 100 strike European puts, each costing 10.22. They purchase 4 100 strike calls, each costing 6.8. Both options have the same underlying asset, expire in 6 months. Okay, got it. Then they tell us about the risk-free rate and they want to know the profit for each of these spot prices. So definitely easier than a test question. And you'll see that with my questions, some are easier, some are harder, some are kind of like the same level. I just kind of put a mix in here specifically to try to illustrate certain points. But for us, so we see that, oh, we've got this combination of puts and calls. So I'm going to write here just a little equation about my portfolio. So my portfolio is that I'm going to write 3 100 strike puts. So if I write, would I go long or short? And the answer is short, right? Okay, so I'm going to go minus 3 puts with strike 100. And then I go, and then I know how much these cost, that's good. And then they purchase 4 100 strike calls. So I'm going to go plus 4 calls with strike 100. Okay, so far so good. And that's my portfolio. It's going to be just that. So since I'm going to want profit, I know that I'm going to have to find the payoff minus future value of the cost. So why don't I just find cost right away? Cost is going to be, and since it's the same portfolio, it's going to cost the same amount. So I'm just going to go -3 of those plus 4 of those. Super easy, not really thinking about a lot of stuff. You could think in terms of cash flows where it would be negative. That's fine. It would be +3 of the one and -4 of the others if it's a cash flow. It's no problem. But here, so each put costs 1022, and then each call costs 680. And so let me just find out what that cost is there. So feel free to get out your calculator. We're going to be using those babies today. I don't know about you, but I kind of like this one. I feel like this calculator changed my life. I don't know about you, the TI-30XS multi-view. You could also have the 30X22SI or whatever. That's a good one too, but I feel like this one's better, but whatever. It's whatever you're used to, whatever you're comfortable with. But I'll be using this and I'll kind of illustrate some of the cool features on it as we go throughout the seminars. So, but okay, well, let's find this out. So -3 times 1022 plus 4 times 6.8. And I got -346. Okay. All right. And then since we're going to need the future value of the cost, maybe I'll just do that right now. So let's go future value of the cost is, well, -346. And then, okay, what they say? Well, continuously compounded. So that's like the R thing, right? So that would just be e to the, so future value, I'm going to go positive 0.05, but for half a year. And so let me just multiply that by times e to the 0.05 over 2. And I got -350, 55. We'll just go dollars and cents for now. Okay, so 355, beautiful. And so they want the profit for each. So, well, first let's find payoff. Okay, so payoff. Now the beautiful part about the payoff is I'm going to use the exact same sign pattern, plus or -3 of the puts and +4 of the calls. So I'm just going to say -3 for the puts, +4 for the calls. And now I just want to think, well, what does a put hope happens and what does a call hope happens? And for us, we know that, all right, a put wants the price to go down, and it's always relative to the strike. So they really want the price to go below 100. And if the stock goes below the 100, the put's going to pay off. And the call really hopes the price goes above 100. So we're going to use that to our advantage here. So now we're going to say, what if the price in half a year is $88? Well, the put wants the price to go below 100. Did it? Yeah, it was at 88. So each of these is going to pay 12. The call hopes the price goes above 100. Did it? No, it was only 88. So that one's going to be a dud. It's just going to pay 0. So the payoff, real easy. And again, I didn't have to worry about the shortness of it. It was already taken care of for me with the negative. Super awesome. So I've got here, I guess I could do this in my head, right? -36, which means, okay, great. That means that the profit is payoff minus future value of the cost. And by the way, I just did the future value of the cost because I'm gonna have to do it 3 times. So I just didn't want to have to write it each time, but I probably wouldn't do the future value separate. I'd probably just do it all in the same thing here. But at any rate, what do we get here? So yeah, just adding it up, -32.45. But not bad, right? So actually the portfolio kind of keeps things real simple for me. I didn't have to think about, like, I remember when I was first studying for this, I tried to think through it and I'm like, okay, I've got this like short put. A put is an option to sell. And then I'm like, okay, if it's 88, I'm trying to reason through it and all these things. And it's like, man, it was like, I would like think myself in circles. I don't know if you guys had to do that too, but it was always a problem. But actually we could keep it real simple. And then it's like, oh, throw the short put on top of that. And then it's like, okay, but you're actually selling that to somebody else. And you want to kind of think, it's like just too much to think about. So we're going to keep it simple. We're going to let the signs take care of the plus or the short and the longness of it. And we can just think in terms of like, well, what does the call hope happens? What does the put hope happens? And just do it from there. So it's super nice. And we do the same sort of thing here. Let's look at the next one. So what about if the spot price was actually 94? So, okay, what about the payoff? And again, -3 of the puts, +4 of the calls. No problem. Okay, and okay, well, again, so the put wants the price to go below the strike. It wants the price to go down under 100. Was it? Yeah, 94. Awesome. So each of those is going to pay 6, the difference. Okay. What about the calls? Well, the call wants the price to go above 100. Did it? Nope, it didn't. It was 94. So those are going to pay 0. Okay, so the payoff is what? -18. And the profit then, really easy. -18 minus future value of the cost. And I got -1445. Okay, and then one more example, just real quick here. So what is now my payoff if the strike or if the spot price is 105? So again, -3 for the calls, +4 for the puts, just mimicking the sign pattern here. That's all it is. I know cost, payoff, and portfolio all have the same exact configuration, which is nice. And so then we're like, all right, so now the price is 105. Well, what does the put hope happens? The put hopes the price goes below 100. Did it? In this case, no, it didn't. So that's just going to be a 0. But the call hopes the price goes above 100. Did it? Yeah, it's at a 105. Awesome. So each of those is going to pay a 5. And so we've got here that the payoff is 20. And so the profit is 20 minus future value of the cost, which is 23.55. Now, just like, I guess kind of a show of hands or whatever, but like, have you ever seen this? Like, is this kind of like how you're used to doing it? And I'm thinking with the reactions, oh yeah, I think you had the check mark and you got like an X for no. So you kind of use those if you want to for like, yes, you've seen it. No, you haven't. Just to kind of get my feedback a little bit like, have you seen this kind of thing here? Yeah, appreciate it. Yeah, thanks. But have you seen, yeah, this kind of thing come up here? And okay, great. Okay, so it's not super new. Okay, awesome. Okay, some haven't. Okay, perfect. No, thank you so much. We're going to see, I'm going to actually come back to this over and over and over and over again throughout the whole seminar. Okay, so you'll get used to it if you haven't seen it. But again, it's just kind of like a way to keep things simple. That's all. Okay, and we're actually going to see it even when it comes to graphing. Graphing is, I feel like, something that's really underrepresented in like kind of in the study materials, because graphing is such a huge, awesome thing, and you get so much power from graphing stuff. Oh, you're going to love it. Hopefully you're going to find this like super helpful. But you can actually solve a ton of problems just by knowing how to graph and to graph quickly. And it's actually really super easy to do. So hopefully you'll be able to be comfortable with that. But usually the main 3 things, we kind of know all the graphs of already. And this sort of goes along with our understanding here too, where, well, a long forward is related to a long call. And if you think about it, it actually just isolates the good part of a long forward, doesn't it? And then for the bad part of a long forward, we just walk away, right? And then the parallel then is like, oh yeah, for a short forward, that's kind of like a long put, because again, it's like, oh, it just takes the favorable part, the positive payoff of a short forward. It keeps the same thing, but then for the bad part of it, you just walk away and go just have a 0 payoff. Okay, all these are the payoff graphs, by the way, the blue ones here. And the payoff graphs are super important. When we say price goes up or goes down, we don't mean up or down on the graph. We mean right or left, right? So when we're like, oh, a call hopes the price to go up, we really mean price goes, well, up, but to the right is what we mean. And if it does go up, great, then we actually get a positive payoff. But if the price goes down, we get no action and it's just a 0. And same for a put. Well, like, okay, well, if the price goes down, meaning left, then we get some action. And if it goes up, well, we just get nothing. And the short would just be the same thing, but negative. So we're just kind of reflecting it about the x-axis. Okay. And that's it. I mean, the short graphs are just the negative or the reflection of the long graphs. And we see that here. It's a nice, beautiful mirror. Now the part, one thing I wanted to bring out on this page is when it comes to the profit graph. So this is Payoff. And it just gives you a snapshot. I'm sure you're familiar with this, but it just gives you a snapshot of all the possible payoffs for all the possible spot prices. On the previous one, we just had 3 spot prices. And we found the payoffs, for each of those, the -36, -18, 20. So we just had 3 sample points, but this one actually does all the payoffs for all the prices, the spot prices in the future. So what we also would like to do is to find out the profit graph. What does the profit graph look like? So the profit graph we know is just the payoff minus future value of the cost. And it's kind of a lot to think through, but basically what that means is we're just going to shift the curve either up or down. That's all it is. That's all the profit is, because we're kind of like adding or subtracting one number from everything, one base number. So it's just, that's all it is. It's just we're just going to shift this graph. The big question is shift up or shift down. Okay, and you can think through it. You can think like, oh, okay, for a long call, let's focus on that one first. For a long call, I'm going to have to pay for it because I purchased it. So I'm going to purchase it. So that's ultimately I'm going to have to pay it. So it's going to subtract off. I guess I'm just going to have to shift it down. And you're right, you do. And that's perfect. But we're going to actually handle the shifting in most cases using a different kind of thought process. We're actually going to use arbitrage. And I know that's like super, like such an ugly word, and I get it. I hate arbitrage questions, but hopefully we're going to do kind of a lot in here. So hopefully it won't be so bad. But arbitrage is actually, it's not really like a horrible concept. It's just like, the problems are confusing, and I get it. But arbitrage, really what that means is it's just saying that everything in the market's hooked together. Like the calls are hooked together with puts. They're kind of like all connected. Like there's a lot of like connections in the market. And if you're not careful, something could be priced wrong. And then you can kind of maybe exploit that mispricing by using some sort of arbitrage argument. And what that would mean is that you can kind of cleverly create some sort of portfolio so that your profit turns out to be non-negative. In other words, like once you talk about your profit, which is everything, right? The money you're expected to get, the money you paid at the beginning, everything, once, like when you're all said and done, if you're kind of expecting to have a profit that's always positive, then that means the short would be always negative. So like nobody would ever do that. There's never a situation where you should kind of like always have a positive profit. Now we'll see one small example to that, counterexample to that later, but it's not actually, there's a good reason for it. So, but for the most part, we can think of, if we're just dealing with all market items, nobody should ever always win, because that means somebody else always loses. And that's not possible. Okay. That would be sort of exploiting some arbitrage argument. So we're going to actually use that to our advantage here, because that means that there should never be a completely positive profit for anybody, or completely negative. So when it comes to these graphs and shifting, we're like, oh, okay, let's start with that long call. I know I'm going to have to shift it up or shift it down. Could I shift it up, or do I have to shift it down? And the answer is, well, I can't shift it up, because then it's always completely positive. It's always above the x-axis. That means that person's profit is always positive. Of course, you'd love that. And if you exploited an arbitrage opportunity, you could hopefully get that. But that would mean then that the person in the short would always be negative, and that's not really fair to them, right? So we should never expect to see a completely positive profit or completely negative. So we realize here, without even thinking too much about it, I've got to shift this thing down. That's the only way. And even with this one here, I'm going to have to, well, I know I'm either going to shift down or shift up. And I can think, all right, well, I can't have a completely negative profit, so I must have to shift it up. Now we could also reason on it and say, oh, well, if I shorted it, that means I received money at the beginning. I received money that's going to add to my profit. It'll shift everything up. But it's actually a lot simpler and quicker to think like, oh, like it's obvious here, I would have to shift it up. And sometimes, honestly, that's all you need to do. And we're going to see this is going to actually have like nicer consequences for us too. But yeah, the red ones here will always be our profit graphs that we're going to put on here. Now we can play around with that here. The put, well, what would I have to do? Shift up or shift down for the long put. And I think, well, if I shift it up, not good because it's completely above the axis. So I guess I'm going to have to shift it down. But it's also kind of nice on this one because I can't shift it down too far. There's kind of a limit on how far I could shift it down. There is like this, because if I shifted it down a whole lot, then I would actually have part of it being completely negative, and that's not good either. So just kind of be a little balance there. I know I'm gonna have to shift it down and shift it down a little bit, not too much. And then with the short call or the short put, I know I'm gonna have to shift it up. I can't shift it down because then it's completely below the axis. Okay. So you can quickly get these profit graphs, which is honestly using an arbitrage argument, but seems kind of weird, but actually it's super, super easy, super quick. And it's going to be super helpful for us too later. So it's nice. We can actually look at these immediately and kind of know which of these do you think is the worst, the most dangerous one to have? By the way, and you can just chat it if you think like call or put, long or short. Which of these do you think is the most dangerous to have?
I think it's a put.
Okay, good thought. Okay, good. And long or short?
I think it's a short.
Okay, so this one. Okay. No,
I'm,
thanks for
is it a short? I think it's a short. I'm going back to like the naked shorts for GameStop.
Ah, good. Okay, good. So we're going to talk about that. Excellent. Because we just saw that phenomenon not too long ago with GameStop. And there's like, oh, there's something wrong with shorts, some shorting thing. And you're close. It's actually, this one is the most dangerous. Now, why is this? Why is a short call the most dangerous? And the answer is because notice how this is the only one that has a potentially infinitely negative profit,
Loss.
which is like an infinite loss. And that's what exactly was happening with GameStop, is that, you know, they thought the price is going to stay low, so they sold all these calls to people. But if they're selling them, then that means they're shorting it, right? So they're down here. But then the price of GameStop went up, which means they're heading into this territory to the right over here. And so the people that sold these calls are having these like really horrible losses because the price just kept going up and up and up and up. And so to purchase a call is pretty nice because you kind of only win and you could have a potentially huge profit from that. But the people that sell it are running the risk of having an infinite loss or like an unlimited loss. And yeah, great. Thanks for bringing that up about that example with GameStop, because that's exactly what I was thinking of too. So good. Now the puts, interestingly, are sort of like the safest in a way, because if you think about it, they have a maximum profit and a minimum profit. They're pretty nice looking, actually. Like the maximum profit would be here. So that number right there, that's for a long put, that would be the maximum profit, and the minimum profit would just be here. The maximum profit for a short put is here, the minimum is here. But for the calls, they could have an unlimited either gain or loss, depending if I'm long or short. Okay. And so you can easily, from this graph, you could say like, oh, okay, I kind of can tell you immediately from the graph what the maximum payoff and profit, you know, are. And I always know how much I'm going to shift it. It's just going to be the future value of the cost somehow. And if you do it graphically, you can always say, oh, I'm going to either subtract it or add it. You don't even have to worry about positive or negative from the graph, because you know like, oh, okay, I guess this would be 0 plus whatever, however much it costs, the future value of its price, so I would shift it up by that amount. So, but yeah, good. So we can actually learn a lot just from these graphs. It's actually super nice. The forward, interestingly, the profit for a forward, we can think here, well, it would be okay to shift it up or to shift it down, which means it might also be okay not to shift it at all. That's okay too. And that kind of gets back to this idea about a forward where they say a forward really doesn't cost any money. And that's okay as long as, I just want to put this little caveat with it, that as long as the forward price is the correct price, then yeah, it's sort of calculated to be the fair price for everybody. So you really shouldn't have to pay for it at the beginning. And so when they say that, it's just a little bit of a, like, just have to be a little bit careful, because if the forward price is the correct price, then yes, a forward should cost no money entering it. And if that's the case, then yes, the profit and the payoff are both the same curve, because there is no cost, right? So plus or minus future value of the cost doesn't do anything. Okay. I know that's kind of a long explanation for this slide, but we're going to see that this is going to be a powerful idea for us coming forward. Okay. Now, one thing that, as I've looked at the different materials, there was 2 graphs that I don't think they really talked about too much, and I thought that was important to include here. One was for the asset, and the other was for a bond. And it's funny, I don't know if like maybe word gets back to some of the platforms, but like kind of after some of the seminars, I'll see sort of like these ideas creep up into like theirs. So I don't know, maybe they're kind of using my ideas, which is great. I feel like that's super awesome. But so you might have seen this, but you might have seen this before too. But so what we're talking about here is like a stock, if I'm talking about just the asset. So you could be talking about basically like a share of stock. So if I'm long in a share of stock, what should it look like? That's kind of what I'm trying to graph here. So the payoff. And remember, so this one might feel a little bit strange, the payoff, but the payoff only accounts for what happens at the end. So if the stock is worth 100, the payoff would be 100. If the stock is worth 50, the payoff would be 50, right? If you're long in the stock, you own the stock. If it's 20, it's 20. So actually the payoff graph looks like that. It's just a line with slope 1 coming right out of the origin. And that makes sense. It doesn't feel like it's the whole story, but it's not, because it's just the payoff. It's not the profit. So it looks like that. That's the payoff. And for the short, then it would look like the same thing, but just reflected about the x-axis there. So it'd just be negative. And that makes sense, because if it's worth 100, well, you're going to owe 100, right? Because when you short, you have to pay it back later. So then we can kind of think of the profit, and we know, okay, profit is going to shift up or shift down. And of course it can't shift up because then it's completely above the axis. So we're going to have to shift it down, and probably it's going to cost a lot. So we're going to shift it down by a lot. But this might remind you of the profit for a long forward, and there is a relationship there, and we're going to talk about that a little bit later too. Okay, but yeah, we know that there's the profit, looks like that. So I'll just put here payoff again, and the red is profit. And same sort of deal here. I know I'm going to have to shift this one up. So we know that the profit for those. Now I will qualify this in a minute, that these two are a little bit more complicated when it comes to like the portfolio payoff cost thing. So we'll talk about that in a sec. A bond, on the other hand, is risk-free. It's something where it's like, it doesn't really depend on the stock, right? The current stock price, it's just a bond. You pay for it at the beginning and you get some money back later, regardless of the situation. So in this case, a bond actually would just be flat. So it's just straight across. It has nothing to do, it's constant. It doesn't depend on the current price. And so it looks like that. In fact, we know how much it's going to pay. We can actually, I want to be a little bit specific about this one, but we know how much it's going to pay. It's going to end up paying in the end, well, I guess whatever I paid for it, but plus interest. So it's going to end up paying the future value of the cost. So that's how much it'll it'll pay off in the future value of the cost. And of course, if that's what a long bond does, a short bond will be just the same thing flipped about the axis. Now, the profit is kind of interesting. Where would the profit shift to? Would it be above or below, or where would it have to be? And well, interestingly, both of those are bad. It can't be above the axis. It can't be below, because both of those violate arbitrage in a way. So this one actually would have to be right at the axis. But that makes a lot of sense, because we've probably heard that a bond makes zero profit. And this is kind of a theme that runs throughout all this material, is that everybody can make the risk-free rate. So the only thing that you should really be like happy about is anything above the risk-free rate that you might get. So you might see a lot of stuff that has like alpha minus R, or like even in the like the other half of the material for like CAPM and all that, you have like, oh, R minus the risk-free rate, because this is the thing that you should be compensated for, everything above the risk-free rate, because risk-free rate is really like, that's what everybody should be growing at. And you're trying to leverage even higher than that. Okay, so it's almost like it doesn't feel right, because you're like, well, if I'm getting interest, aren't I earning profit? But not in their sense of the word. Okay, so just have to keep that in mind. And same thing down here, by the way. So still at zero there as well. And that makes sense even with the formula, because you're like, oh, well, this profit would be payoff minus future value of the cost. But well, if my payoff was future value of the cost, then I'm going to subtract that off and I'm going to get zero. So we can even see it mathematically. Works out there too. Okay, now I mentioned before that these two are handled just a little bit different. There's one extra important thing to do when it comes to these. So if my portfolio is plus one share of stock, okay, then my payoff, well, I guess what would my payoff be? So if I had like, so I'll say S0 just to be more specific. But any ideas? What would be the payoff? Any thoughts? And if you want to chat it, that's cool, or unmute's cool too. It's no problem. But you might think that it's going to be, well, plus, which is good. That's a good idea. That's perfect. That's good. But you might think it's like, well, plus, I guess whatever a share of stock will be at that time. And that's partly right. Okay, and this is the little subtlety here. If the stock pays dividends, I'd also have to include that. But that kind of makes sense, right? Because you're like, well, if I purchased one share of stock at time zero, I guess I would get, at time t, I'd have, well, not only whatever the price of the stock is then, but also then maybe any dividends I might have got along the way. So if it has discrete dividends, then maybe you'll also get plus, the value of the dividend, the future value of the dividend up to that point. So you could do something like that. Those don't really come up with this too much, but it is true. The thing that does come up that's super important is continuous dividends. And this is something I did want to talk a little bit about. What does it mean to get continuous dividends for these? Like, how should we think about that? Because it's not like discrete dividends where you're like, oh, I get this check for $5 or whatever because I got a dividend. It's paying dividends continuously, and it's not just like a theoretical thing either. Like, we want to be able to kind of think about this, like, how can I actually, how would they actually pay this if there's stocks with continuous dividends? And the answer is actually, it's really insightful, because it makes a whole lot of formulas make a lot of sense. But when they have continuous dividends, that's that's like the delta thing, the continuous dividends. The way that they credit it to you is they actually just give you more shares of the same stock. So when they say something like, oh, it's whatever the price will be then, but because I held it for so long, I'm also going to get more shares of that same stock. So you'll see often in these formulas, e to the delta t in there. but it's not like an FM where you're like, oh, okay, I've got this force of interest and you're kind of moving something forward. Because notice how it's not S0 e to the delta t, like I'm moving the price from here forward. That's not what's happening. What's happening is I'm gonna get these continuous dividends. And so I'm gonna have, it's gonna accumulate as if we did it in FM, like it follows the same kind of system pattern. It's sort of like continuously compounded interest. But it's gonna be, I'm gonna have whatever a current price of the stock is then, but I'm also gonna have more shares of that same stock. So we're going to see this little phenomenon come up a few times throughout the seminar series. Sometimes they'll write it like this, where stock with dividends, I'm going to purchase one share, but then I'm going to end up having whatever the price is plus a bunch of, so plus some extra shares of stock. So that's how it's going to be handled for us. Sometimes they'll actually sort of like front load it so that you'll end up with exactly one share at the end. So they might actually, instead, they might do the portfolio is, so they might do S0 e to the negative delta t. So then when they accumulate it with shares of stock, they're going to end up with, well, the price, and then I'm going to have this, but times e to the positive delta t, so that's going to cancel out. So then I'm going to end up with exactly one share at the end, right? So they call that tailing the position, but you're kind of like, if I know if I know it's going to give like 5% dividends, let's say, and I have it for a year, then what I'll do is maybe instead of buying one share and end up with like 1.05 shares, maybe instead I'll do something like I'll purchase like 0.95 shares of stock so that it'll accumulate exactly to one share at the end. And that's something that they're going to do a fair amount, especially with arbitrage stuff, because you'll want to end up with exactly one share instead of start with one share. Okay, so that's what the continuous dividends are going to do. And it makes sense with some of the formulas as well, because it is a little bit off topic, but when we talk about alpha for a stock, alpha was, that was the expected return. Expected return of a share of stock. Oh, okay. Oh, sorry, got a question. Can I repeat the S0 e to the, okay, yes. So let me come back here for real quick before we talk about the expected return, because it's important. So we realize that if we purchase a share of stock with dividends, it's gonna, the payoff won't just be like a single share anymore. It's actually gonna be like extra shares as we go, plus whatever the current price is. So if we wanted to just purchase a share, great, then we just realize we're going to end up with more than one share later at whatever the price is. But we could kind of, if we wanted to end up with exactly one share, that's a different kind of question. But we could do that as long as we purchase a little bit less than one share of stock. So this e to the negative delta t, you want to kind of think of as number of shares of stock. And if I purchased e to the negative delta t shares of stock, over that time, it'll accumulate to exactly one share. So you're kind of like preempting it or front loading it a little bit cleverly so that you end up with exactly one share. So yeah, good. Oh, good. Yeah, please. And anytime you have questions, please feel free. Now that does get us to this whole idea about the expected return. So what the expected return is, in fact, I don't think I really talk about this too much on this seminar, but we'll see that in the next one and the one after. But the expected return is basically like, oh, if you purchase a share now, how much should you expect your wealth to grow because of that purchase over the time? And that's your expected return. And we kind of see here that there's actually sort of two factors into our money growing for us, right? So one of them is that, well, one of them is that I could actually get more shares of the same stock. So more shares of stock. So if I purchase one share, well, in the future, I might end up with more than one share especially if I've got that delta. Continuous dividends, they're going to credit it as more shares. So that's one way that my money could actually grow. But then the other one was this idea here where, well, I'm not just going to have my current price, but I'm going to end up with a different price per share also. And we're kind of assuming that hopefully prices of stocks will go up. So my expected return also includes this stock price change. Hopefully increase, but stock price change. So not only do I get more shares of stock, but the price of the stock will change. And both of those things are actually wrapped up into the expected return. Okay. So sometimes you'll see in these formulas, they really want to isolate number two. They want to really just talk about like, well, what can I say about the stock price? I just want to know. In fact, you might think expected value of ST. What is the expected stock price in the future? So what they do is they actually, it makes a lot of sense because they're actually going to take, well, alpha includes both delta and stock price. So what I'll do is I'll just kind of remove the delta, and that'll give me just stock price increase. In fact, remember this formula is just S0 e to the alpha minus delta t. But that alpha minus delta, you'll see this all the time because they're trying to isolate something just about stock price only. So you saw it in like Black-Scholes formula, you see it in these expected price formulas, you see the alpha minus deltas a lot because that is actually now isolating just the stock price increase. In fact, that's what they call the rate of appreciation. Is that right? So in other words, if just like how much is the price changing, growing, just the stock price, that's alpha minus delta because it's just isolating component number two for stock change. So for what it's worth, but you kind of see that, you're like, oh, okay, I see the alpha minus delta. Oh, that's what it's doing. It's just removing the whole reason why my money's growing from the extra dividends. And it's just isolating stock price. And that's it. That's all they're doing. And that's why in a lot of these formulas, you'll see just alpha minus deltas, Black-Scholes, this formula, a lot of those because they just really want to know about stock price only. Okay. So what that means for us is that when it comes to portfolios and payoffs, if we ever have a stock and it's a dividend paying stock, then we just have to make sure to incorporate that into the payoff. If it's a non-dividend paying stock, then you'll never see that and you won't see it. It makes sense why we wouldn't. Okay. For bonds, by the way, the same sort of thing is true that for portfolio, if I purchased a bond at time zero, I'm going to spend a certain amount of money. So my payoff won't just be the bond price again or current bond price or whatever, but it'll just be like the bond plus interest, right? I mean, because that's what the payoff will be in the future. I spend a certain amount at the beginning, but then I'm going to pay a certain, it's going to pay that plus interest at the end. So my payoff will just be plus B and then E to the RT, right? So just keep in mind for these two, and maybe this is why they sort of avoid these in a way. But just for payoff, I might have to include this into the equation. Okay. So for those, I can't just do plus and minus, but I just have to include dividends or interest if that's the case. But it makes sense. We got a question here too. Is there a relation to be made between the forward and stock prices? The graph of profit asset looks like, oh yeah. So it's true. Yeah, good. So we'll talk about this a little bit later, especially when it comes to arbitrage. But yeah, there is a relationship between a long forward and that profit. So good. Yeah, excellent job. Good question. All right, now let's get into graphing because this is such an important thing. And we'll do the first couple a little slow, but then we're going to kind of accelerate because I have a lot of pages about graphing on here. I don't know how many pages, like 4 or 5 or something like that. So, but I just wanted to show you sort of the power of being able to combine graphs. And it's actually really easy. Sometimes people make it harder than it is, but it's actually super easy, super simple, and you can get tons of insight by doing it. So okay, so we'll kind of do our portfolio here as a plus call plus a put, so I guess long for both. and both have the same strike. So, okay, we'll just kind of graph those out here. So a long call at 70, and hopefully you have those memorized already, but if you don't, it's okay. We know a call hopes the price to goes up. So that means to the right of 70. And if it does, great, it's going to have some payoff. And the put hopes the price goes below 70 to the left, and there's where it's going to get some action. So it's going to look like that. All right, now to graph the combination, you could probably already see it anyway, but we'll use this as an example here to start. We realize that on the left side here, 70 seems to be the place where it kind of does something different before and after. So I'm going to put 70 as kind of a marker here. Now for adding graphs, combining graphs, we're going to need first an initial point. I think it's just best to do it on the axis. Let's first get the initial point, and then from there on out, we're just going to use slopes. So all this, like, you guys are mad math students, you know, totally all about slopes, what they mean. So we're going to use that to our advantage here. So first thing though is we just need some initial point. So for that, we're just going to kind of say, okay, well, that's a 0, and this is, well, by slopes here, this is a slope of a -1. So because I went back 70, I'm going to go up 70, right? That's what a slope of 1 means, right? Rise over run. I run 70, I rise 70 kind of thing, you know? So this is actually 70. You could even, if you want, you could think of it as like, oh, this is a 45-degree angle. It's like just a slope of the 45-degree slope. And so this distance is the same as that distance. And any of that's okay. Like you want to really like allow yourself to use the cool math stuff that you already know. So that's up at a 70. So a 0 plus 70 is 70. So that means that's where it's going to start here, 70. Okay, the combined initial point. And now from here on out, we're just going to do slopes. So we're going to look at, okay, what is the slope before 70? Well, slope here is a 0, and here's a minus or -1. So then the combined slope would be a -1. And so I know that I'm going to start here at the 70 and go -1 slope. And it's going to go, well, since I went over 70, it's going to go down 70, and it's going to hit right at the axis. And then after 70, I'm going to have a positive slope, a 0 slope. So together that makes a +1 plus a 0 is 1. Now I'm just going to have a +1 slope from there on out. Okay. And then, so what's this one called? Anybody remember? A 70 strike. Anybody remember? Not a collar. Good call though. Straddle.
Is it a straddle?
Yeah, great job. Good job. Excellent. Good. So straddle, good. Now the way I remember it is like if I flipped it over, I'd kind of feel like it looks like somebody's legs like straddling a fence or something. I don't know. However you want to do it, but the weirder or like the kind of more awkward your illustration in your head is, kind of the better it is for you. So that's what I think. Like, it kind of looks like a pair of legs, and so it's a straddle. Okay, question now: shift up or shift down? Where would the profit be without thinking about it? So how many people think up? So we'll go yes for up and no for down, or green for up and red for down. What do you think? So when I shift up or shift down, and okay, it looks like a few answers here, but good. Actually, we're going to shift down. Awesome. So we're going to shift down because shifting up by arbitrage, and we could do that with combinations of graphs too. Arbitrage, well, that's completely above the axis. That's kind of a no-no. So yeah, we're going to have to shift it down. So that would be the profit. Now you could think of it in terms of these. You purchased both of them and stuff, but that's kind of a long way around. We get there a little quicker. All right, good. And then that's going to actually be important here for some of these other ones too. So, okay, what about a call at 80? So I'm going to kind of go here at 80 and a put at 60. So call at 80 is over and up. And a put at 60 is down and over. So now I've got two important numbers. So I'm going to have a 60 and an 80. And And so for me, I might kind of put a little reference mark here. Like I need kind of one for 60 on that and one for 80 over here. Because I know that now I've got like, well, what happens before 60, between 60 and 80 and after 80. So now I kind of 3 intervals. So I'll just put like a little tick mark in here, just kind of relative to the parts that are on there just to help me out. But we're going to do the same thing. Let's find our initial point. So I got a 0 here. And that one there, what do you think that is? If you're saying 60, good job. So 0 plus 60 is 60. So my initial y-intercept basically is 60. And now I can do the slopes. So I got 0 slope minus slope means -1 slope. And oh, that's pretty handy because I'm going over 60, down 60. That's going to hit me right at the axis. Beautiful. Love it. And then, okay, what about between 60 and 80? 0 slope. 0 slope means 0 slope. And then what about after 80? Well, +1 and a 0 slope means a +1 slope. And it's just going to be +1 after that. Okay. Now this one's called a 60-80 what? Strike. Strangle, good. Okay, great job. Strike, strangle. Okay, so that's a strangle. Not sure what the history behind that is. But okay, profit, shift up or shift down. What do you think? And if I shift it up, that'd be bad. So we're gonna have to shift it down. Okay, so good, perfect. If that's what you're saying, awesome, good job. Now, one thing we want to ask is, how about this red one compared to that red one? So I've got 60, 70, 80. So I know they both shift down. Can I say anything about it? Like, could it be something that looks like that? Where one profit graph is completely above another profit graph? Anything? Do you think that's okay? Or does it have to kind of like crisscross a little bit? Like something like that? What do you think? But it's funny because it's going to be the exact same arbitrage thing here. So the answer is that this is not possible to have one profit graph completely above another profit graph. Because if we did, we could just, go long in the top one, short in the bottom. And then we would always make the difference, right? That's what we're going to do. And the difference here would always be positive as our combined profit, which would mean we would end up with a completely positive profit, right? So it's cool that arbitrage also allows me to know this fact that I should never really expect one profit graph to be completely above another profit graph. They've always got to kind of crisscross somewhere. So I know without even trying, basically, that these two graphs are going to have to sort of intersect somewhere. You're going to have to crisscross, and maybe some of the effort will be to try to find out those intersection points. But you can say if there is no arbitrage, that this has to be the case. It's pretty powerful, right? Like, without even really knowing too much about it, we can get some pretty awesome results. Okay, now it's going to be even cooler in a minute, I promise. Okay, so now let's do the next one. Call it 60 over and up, and to put it 80 down and over. So again, I've got the 60 and 80 here. And okay, well, I guess I just need my initial, oh, sorry, I'll put the little reference marks on there. So 60, 80, 60, 80 for the two graphs there. And my initial point now, so I guess I'm going to have a 0 here and 80 for there. And again, just kind of by slopes, like a slope argument. And so my initial point will be up here at 80. Oh, then someone asked a question too about, do they have to be on the same stock or asset? These two? Yes, they do. Yeah, they would have to be on the same asset for sure. Yeah, good. Good call. Okay, well, let's see what happens now. Okay, I've got a 0 slope and a minus slope. So before 60, a 0 and a minus, it's a -1 slope. So I'm going to start at 80 and I'm going to go down with a -1 slope, but I'm only going to travel over 60. So where do you think I'm going to end up? Am I going to end up at 0? What do you think? And if you were saying 20, you are totally right. You're going to end up at 20. Why? Well, because we've got this slope of a -1, and we know it's like rise over run. So if I go over 60, it's going to drop by 60. But I was at 80, so down 60 takes me to 20. But that's okay. It's no problem. It is what it is. It's no problem there. But good. So it doesn't actually hit all the way down to 0, but it stops at 20. Okay, what about between 60 and 80? Well, I've got a positive slope, negative slope. So those kind of cancel out and I end up with a 0 slope. So that's cool. No problem. A 0 slope there. And then what about after 80? Well, a positive slope and a 0 slope is a positive slope. So it looks like that. So almost exactly the same as this blue curve here, the other strangle. In fact, this would also be considered a 60-80 strangle, even though it's not at 0, but it's at 20. It's like, it's kind of bottom is at 20, but it's okay. It's the same shape. That's all they care about. So what about the profit? Would I shift up or shift down? And I know I'm definitely not shifting up, but even shifting down, I have to be a little bit careful because, well, shift down, but could that be the profit? I did shift it down, but still that's not enough, right? I need to shift it down a little bit more. I need to, so that it dips at least some below the axis in order to not to violate the arbitrage possibilities there. So I know it has to look like that. Now, big question, how does this profit and this profit relate? Are they the same, or it'd be pretty weird if they were the same, because the payoff for one is exactly 20 above the payoff for the other, but profit kind of takes into account like future values. It's got like interest in there. So like, does that change it any? But we could think of it like, well, if one of them was like a little bit higher than the other, I would actually have an arbitrage opportunity, because then I would go long in the top, short in the bottom, make the difference, which would always be positive. So kind of the amazing thing here is that these are exactly the same. The profit graphs are exactly the same, even though the payoff graphs are shifted exactly 20 away from each other. Crazy, right? But it's true. And this is a pretty awesome thing to be able to take advantage of sometimes, because if you ever have like some sort of combination of stuff, but it ends up to be looking just like a call or something like that, then if it's all market items, you can actually say the profit of your combination will look exactly like the profit of a call. No questions about it. It's exactly the same. It's pretty awesome, as long as it's all on the same asset, as Jesse was bringing out. So pretty cool, right? Like, so you actually get a lot of power. In fact, we see a lot of these combinations. The common theme is the profit. So sometimes they could actually tell you that you've got some 60-80 strangle. We saw here that there was actually two totally different ways that we could have made it. We could have had this combination or this combination. And we might think like, oh, okay, well, which one do they want me to use? Sometimes they won't tell you because it won't matter, because they're just going to be talking about profit anyway. So that's one thing. The other thing is sometimes they might actually tell you like, oh, you are constructing this where the payoff is above 20 or something like that. They might include some sort of statement about the payoff, because there might be more than one combination to get you the graph that they're after, or the combination that they're after. So they might say like, oh, okay, you construct a 60-80 strike strangle using calls and puts where the payoff graph goes from 20 to infinity. And then you would realize like, oh, okay, they must be talking about this one and not that one. Both of them are perfectly legitimate strangles, but they might say that, so you know, oh, okay, they must have meant this combination instead of the other one. And then from there, they might ask a kind of question for it. Okay, but the profit will stay the same. So sometimes you might use this combination, but they might have thought of this combination. You're like, oh, why do we have to use that one? I thought about this. And maybe you're both right. Might totally be fine. Okay, if they're just talking about the profit, because the profit shouldn't be different. It should be the same, no matter how you construct it. Okay, payoffs might be different, but profits would be the same. Super powerful idea, but it's actually pretty simple, right? It's kind of a simple thing once you kind of embrace the arbitrage stuff. So I feel like it's pretty good. All right, what about if we have something short? So what do we do there? Well, okay, so a put at 60. So that is one where a put goes down and over. And what we're going to do is instead of subtracting graphs, we'll just keep it simple. We'll just always add. We'll just always add graphs, but we can easily make the graph of a short. So if I've got strike at 80, we know call gets action if the stock price goes above 80, so to the right. So in other words, if the stock price is less than 80, it's not going to get any action. And then since it's short, I know that it's actually going to go down instead of up. But it's going to have like activity to the right of 80. So we can always reason on it like that. All right, but actually from here on out, it's just like the other graph stuff that we did. So we're going to have a 60 and an 80. And okay, let me get my initial point. So my initial point here is 60. Here is 0. So I'm going to start at 60. And okay, let me put my reference marks in there, 60 and 80. So I got 60, 80, 60, 80. And I just want to think about the slope. So I got a -1 slope, a 0 slope is a -1 slope. And okay, start at 60, go over 60. That means I'm going to end up at 0. How about between 60 and 80? I got 0 slope, 0 slope, gives me 0 slope. And then to the right of 80, 0 slope, negative slope means negative slope. Hey, now anybody know the name of this one? This would be a 60, 80, they might say strike or not, but 60, 80. And I think this one's kind of interesting because to me, this part here, for some reason on this, it kind of looks like a collar for a shirt. And that's actually what it's called. It's called a collar. So I kind of remember this one like, yeah, that sort of looks like a shirt collar. It's funny because like this one has the same thing and so does that, but to me, it doesn't look as much like a shirt collar. This one is the collar. So for whatever, but whatever. So whatever you're kind of thinking there. Okay, so the collar, 60-80 collar, 60-80 strike collar, something like that. Now, big question, profit, shift up or shift down? Could it shift up? Yeah, actually, that's okay. It could. How about down? Could it shift down? Yeah, as long as it doesn't shift down too much, that's okay, because I still do have some of it above here. So this one could go either way. It could shift up or shift down, which means that there's a possibility that it might also not shift at all. There might be a possible way to get this where it wouldn't shift. And what does it mean if it doesn't shift? Well, that means that the cost was 0. So for collars, it's possible for 0 cost collars. Okay, and we get that free really basically from just this arbitrage argument about shifting. That's it. But it could be, I mean, it just depends on the price. You'd have to kind of go case by case basis. But basically, I'm going to pay for one, but receive money for the other. So it's like, if they somehow cost exactly the same, then great. I'm going to pay for one, but use the money I get from the other to do it. So I'm going to net a 0. Totally fine. You might have to kind of play around with these strikes to be able to do it. But yeah, it's a possible way to do that. And companies love stuff that costs 0. because we're going to see when it comes to hedging, hedging is basically protecting yourself from something, but we can actually combine a collar with some other stuff, and which will actually just kind of like change the future payoff, what it would look like. And companies love to do that for free. They love to say like, okay, I've got this current payoff structure, but what if I kind of like do the zero cost collar and kind of combine it with the other thing? It's going to totally change everything, but for free. You're like, well, why wouldn't we do it? If it helps us to feel better about our profits or whatever, why wouldn't we just kind of combine it with this thing to do it for free? And they love doing that. And we'll see an example, but we'll see something like that a little bit later today too. Okay. A couple other things here. Just want to do a few other types of combinations of stuff. And again, if you have any questions, please feel free, just chat them in there. I know we went through it kind of fast, but it's kind of a doable idea, right? Adding these graphs. So the other kind of ones that you're responsible for on the test are spreads. And basically what a spread is just where you use the same type of options. So in other words, like all calls or all puts, you can create these using all calls or all puts. That's what a spread is. Okay. So the two that we're interested in are a bull spread. So the payoff looks like that, and the bear spread, the payoff typically looks like that. Now we're going to see that there's going to be two different ways to make these things. And one of them will have like the sort of like dark blue payoff, and the other one will have the light blue payoff. But we know that no matter what the payoff is, the profit will have to shift to the same exact thing, amazingly. And so there are two different ways to do bulls and bear spreads. One with calls, one with puts, and they'll give me different payoffs. But the profit, we know the profit will have to, well, shift actually between these two, won't they? So the top one would have to shift down, and the bottom one would have to shift up. So the profit will be exactly the same regardless of how we construct it, but no problem. And even for the bear, it's going to have to shift somewhere into the middle. That's going to be the profit. But yeah, let's see if we can kind of see how we can pull a combination apart into its pieces. Okay, so now we're going to kind of, we're going to see how we can kind of envision this in case we have to disassemble a graph and see kind of what its components were. It's not very often you have to do that, but I thought it was just a good exercise for us. So to me, if I did this with calls, I know calls look like, like that and like that. Right. So I've got like kind of those sort of graphs kind of in my mind, and I'm looking at the shape of this and I'm like, well, it kind of looks like here, if I did a call at 60, it would look something like this. So I'm thinking I'm going to have to do a long call at 60. But then after 80, I see that, well, I'd really want to not change anything before 80, which is awesome because that would be like if I had like a zero slope, zero height, zero everything, a total zero. But then I'd actually want to negate the slope by 1. So here it has a positive slope of a 1, but I really want it to have a positive slope of, or to have a slope of a 0. So I'd need to combine it with something with a negative slope, and that would actually be this short call at 80. So I could kind of like envision here how I'm going to be able to deconstruct this. And I'm going to need a long call at 60 and a short call at 80. And the short call at 80 counteracts that sort of positive 1 slope to sort of bring it back down flat. Okay, so kind of a cool idea. So we could do that. So we see that one way to construct a bull, a 60-80 bull, would be a plus call at 60 minus a call at 80. And the interesting thing is you can do the same thing with puts. And so I'll tell you kind of the amazing thing. To me, this was surprising, but you would actually do plus a put at 60 and minus a put at 80. So I'm going to leave that for homework for you, but try that combination. It's exactly the same order. I was thinking like if it's puts, maybe the order would be reversed, but it's actually the same exact order. And for this, you're gonna see that you'll get that as your payoff, but that'll be your homework. Try it out, and we'll see. We'll kind of get an idea here when we talk about the bear, sort of an easy way to do puts, because puts are kind of nice because they're zero to the right. So in a way, it's kind of nice to almost think of like starting from the right side and working your way to the left if you're using all puts, because puts are zero out there. So you're like, oh, okay, so basically this sort of looks like, would that be a long put at 80? Doesn't it? So kind of generically, that's what that one looks like. It looks like a long put at 80, but then again, I'd sort of want to counteract that slope to the left of 60. So everything to the right of 60, I'd want to stay the same. So I'd want basically a graph that would have like a total zero, zero slope, zero height, zero everything to the right of 60, but that would have maybe like the opposite slope before it to kind of counteract the one that I have. So that's why we end up seeing that for this, we do have a short put at 60. So I'm going to have a positive put at 80 minus a put at 60 to create a bear. And again, I'm using all puts now, but now I've got the higher strike first and the lower strike later. Okay, higher strike for the long, lower strike for the short. And interestingly, if I did it the same order, but with calls, plus call at 80, minus call at 60, and again, this will be your homework, but try doing that combination, and you'll see that you'll get the exact same shape, but it'll just be this one down here, the one that's shifted down. So some weird way, somehow that one has a payoff of 0 to negative 10. So, but it's okay. Or negative 20, sorry, 0 to negative 20. So they might, kind of like what we were saying before, they might specify which combination they might say. They might say like, okay, you're constructing a bear using either calls or puts, but your payoff graph has a payoff between like a minus 20 and a 0. So they're telling you specifically, oh, it's a bear shape, which is, high and then low. But then since the payoff is 0 to negative 20, it must have been the way that you did it with calls or something. So they could do something like that. Now, a little bit about their names is probably you kind of know about that with the market, especially right now, kind of like in a bear market, which means like bears kind of want to go hibernate and sleep and just kind of retreat and go away and come back later when things get better. So we think of like a bear market is a market that's going down. Now, this, you might think like, oh, okay, yeah, this one's going down. As I move to the right, it goes down, but that's not really what they mean. Actually, if you think it's a bear market, you would love to get money for stock prices going down. And that's actually what's happening here. As I move to the left, that's where I'm getting my payoffs. My high payoffs are to the left for low stock prices. And my higher prices over here have the low payoffs. As opposed to a bull, which is strong and full of energy and really wants to, make some stuff happen. That's a good market. A market is, bullish if it's the prices are going up. So that's why this one will pay. It has a high payoff for prices to the right. So for values, high stock prices, it'll pay off. But for low stock prices, it has a no payoff basically, or less of a payoff in those situations. Okay. So that's what they're called. There's also something called a ratio spread. A ratio spread would just, it looks like this. And we can kind of think of how this would be constructed with, well, it kind of looks like a call right away, right off the bat. So that one looks like a positive call at 60. So actually this one is going to be a plus call at 60. But then I think like, well, after that, I really don't want it to do anything to the left of 80. I actually want to keep that exactly the way it is. So I want something that's going to pay nothing to be to the left of 80. But now I want it to be, instead of a positive 1 slope, I would actually want it to be like a negative 1 slope. So I do want to kind of like drop that slope a little bit. But if I just combined it with one of them, one negative 1 slope call, then it would actually sort of the positive plus the negative would flatten it out. So I'd actually need a second one to end up with kind of cranking it down a little bit more to end up with actually a -1 slope. So I'd have a +1 slope, but I'd actually have to subtract 2 to get a -1 slope, right? And we kind of sort of like looking at it like that. So that's what a ratio is that it's actually going to be 2 short calls at 80. So I'm going to have a positive call at 60 minus 2 calls at 80. And this is where ratio gets its name, because in general, it could be plus M calls for 1 strike minus N calls at some second strike, strike 2 or whatever. So they're saying, oh, these occur in some sort of ratio, M to N. I have like so many of these for each, so many of those. And if we think about profit again, well, profit, I could shift up. That's completely possible. I could actually shift down too, as long as it's not too much, which means that there's a possibility of me maybe not having to shift at all. So again, for ratios, it's possible for zero cost ratios. Ratio spreads. So that's possible too. And I guess that makes sense because I would have, I'm going to pay for this, but receive money for this. So I guess in this case, if these, the ones that I charge for cost exactly half of this one right here that I'm going to pay for, then yeah, I guess I could kind of, I would end up spending 0 ultimately. So that's okay, because I'm paying for some, receiving money for something else. So, all right, last one here is a butterfly spread. And okay, so for butterfly spreads here, and again, it's a spread, so I can make it with all calls or all puts. And we'll see that actually we can make it another way too. But I wanted to start off with the asymmetric just to kind of help us to have a system for finding the right coefficients. Because we know it's like, well, we're going to have like all of these strikes in there. A call at 60, a call at 75, and a call at 80. But we just need to know, like, well, how does that happen? Like how many of each would I actually need? So I'll show you what I do, and won't get into the details, but try it later and you'll kind of see why this is the case. But here's how I determine the ratio of like how many of each of these to buy. So I look at the distances here. So that distance is what, 60 to 70, so 15, and this distance is 5, which means a total distance of 20. Now, what I'm going to do is, just for me, I'll kind of reduce that to lowest terms just to kind of make some sort of simplest combination, because I could actually, any multiple of all these will also give me the same shape. It just kind of depends on how tall it is, that's all. So I'll sort of reduce it to lowest terms. I guess I can divide 5 into everything. So I could get like 3, 1, and 4. So the nice thing is that the 4 goes right in the middle and it's short. And the long ones are the outside ones. And those are going to be these numbers, but reversed. So I'm actually going to get 1 of those and 3 of these. And just like with the bear and the bull, it doesn't matter if I use calls or puts, it's exactly the same order for both. Kind of interestingly, it's going to be the exact same thing. And unlike the bear and the bull, these two payoffs will actually give me exactly the same curve. Not one won't be shifted in the other. They'll both actually give me the same. So also for your homework or for break or whatever, try graphing both of those combinations and seeing if you get exactly this kind of thing. So it's asymmetric because, yeah, it's kind of like, it's not in the center. It's not at 70. The point is not at 70. That would be symmetric. This one's a little bit off, but if it's not the same, if it's not symmetric, then yeah, we can just kind of do this sort of thing. So the ones that are symmetric are even easier. we see with those, to get the same numbers here, we know we're going to have, well, a distance of 10, which means distance of 20 total. Reduce it to lowest terms means I'm going to have 1, 1, and 2. So I always have 1 of these, 2 of those, and 1 of those. And that one's even a little nicer because you don't have to know which which one goes with which. The middle one is 2. So the big and the small strikes are long, and the middle strike is short. And so this one is going to be made with, well, I could do it at a call of 60 minus 2 calls at 70 plus a call at 80. And I could even do it with puts the same way. So I could do plus a put at 60 minus 2 puts at 70 and then plus a put at 80. Oh, and then we have a question here too. So I'm going through it a little bit fast. So sorry about that, but just don't want seminar being too long. But so the question was like, oh, how did I get these 3 here? And so all I did here is I just took these distances and I kind of scaled them all by before. So that's how I got them. And then the big question is, well, like, okay, the 3 would be the first one, the 4 would be the middle, and the 1 would be the last one. It just turns out that actually it's just reversed. The slope here has to be, yeah, the slope here has to be like more shallow. This has to be a super steep slope. So I'm going to kind of need to like have more of those in a way. So you kind of think of it like that. Well, actually, this is the reason why that's so steep is because this one, but then this is going to have to compensate for that sort of steep slope there. But yeah, oh, sorry about the connection. Apologize. Yeah, so weird Zoom, you know, sometimes there's those connection issues. But yeah, please, yeah, absolutely. Any questions that you have, let me know. For the butterfly too, by the way, it's the symmetric one. It's interesting that you can also make a butterfly with one of these and one of those. And remember, oh, that's like the pair of legs. So that's the straddle and here's the strangle. You can actually make it with that too. So sometimes they like to ask that. So this would have to kind of correspond to sort of like the point. And then this sort of compensates for the outer edges, right? So we would need, so basically we're looking at this and we're saying like, okay, we need it to basically look like that point in the middle. So we want the other thing to pay 0. But then on the edges, I kind of want to counteract that slope here and counteract this slope here. So I'm going to need something that's going to have the opposite slopes for each of those wings out there, right? So that's why this one had a positive slope over here. So we want something that has a negative slope there. So those combination slopes then will give me 0. So it's going to point flat to the left. And then here too, these ones will sort of compensate for each other. They'll counteract each other. And I do see that actually I would get this whole, I'd get the butterfly. And in fact, when I do this combination, I'm actually going to get this blue one below it. And that makes sense a little bit because here this is a total 0 between 60 and 80. So that one's going to contribute nothing. So the combination will look exactly like this one, not shifted at all, but it's going to look exactly like it. And so it's going to be the one that starts at the axis and goes down. And then, you know, I'll get the compensation. You can graph that also for homework just to kind of see it making sense. But yes, you can create a butterfly with all calls, all puts, and you can even do it with a straddle and a strangle if you do it right. And again, the payoffs might not be the same, but the profits will always have to be the same. And of course, we know that these two, even if they're made from totally different things, the profit will always have to graph to the same thing. Okay, so now let's put some of this knowledge that we've learned here to good use, okay, in our second example. Okay, but up to this point, any questions? I'll just pause here. And any questions when it comes to the graphing? And went through some of it a little fast, but just want to just give you kind of like the idea here, because you can sort of sort through the details as you go. But I wrote up a question that I've never actually seen on a test, but I thought it'd be like a great test question. Might actually be harder than a test question, but we can do it with what we know here. But we have to be a little bit creative, or like we kind of have to use the force a little bit and like not try to like stick to a formula, but like really just use what we know to be able to solve these. So, all right, but let's go to that. Let's do question number 2, example 2. Okay, so Regis purchases a T-year 90, 100, 115 asymmetric butterfly on a stock using only the puts whose premiums are given here. So these are put premiums. Okay, the butterfly has a maximum payoff of 120. Okay, so here they're telling us about the payoff. So that's good. And a minimum payoff of a 0. So we know that the payoff is going to be between 0 and 120. Okay, that's good to know. And then, okay, so we get the effective T-year rate is 15 or 16% and determine his profit if the spot price is 97 in T-years. Okay. All right, well, let's kind of first see what we could do here. Well, we know since it's a 90, 100, 115 asymmetric butterfly, we know what that looks like. And since it's all call or all puts that we're using, we know that it's the one that's going to be above the axis. So it's going to look something like 90, 100, 115. And it's the one, since it's all puts, we know it's going to look something like this. Not like the one that's down like that, but the one that starts at the axis, it goes up. And they also told us that ours, we know that the maximum payoff, so since this is the payoff graph, it's going to have a payoff between 0 and 120. So our job here is to sort of fit this kind of thing here. So exactly how many puts of each am I going to need to buy? That's the big question. And it's a little easier said than done, but we're going to see that we can actually do it pretty easy, but we just have to be a little bit careful in some ways. So first things first, I know basically how to create this 90, 100, 115 butterfly with puts. And for that, I'm going to kind of use that whole ratio thing that we were talking about. So I got here's a distance of 10, here's a distance of 15, which means a total distance of 25. So I'm going to kind of reduce it to lowest terms just to keep it as simple as possible. I guess I'll divide everything by a 5. So I'm going to get 2, 3, and 5. So I know basically my portfolio is going to have to look something like, well, I'm going to read them backwards here now. +3 puts at the lowest strike, -5 puts at the middle strike, and then +2 puts at the high strike. Okay. Now, the only problem here is we know this has the right shape, but we're not really sure like how much to stretch it. It could be that this combination here looks the same, but maybe it's like something like that. Or it could be, you know, something like this, but we're not really sure how it's scaled. So I need some way to determine, I guess for this green combination, like, yeah, like where is the highest point? Is it at 120 or is it higher than 120 or lower than 120? Like where is it? So what I have here is this green combination. I'm not really sure where it is. I know it has the right general shape. I'm just not sure exactly if the payoff thing matches. Okay, that's the question. So I need to find it. Now, well, so what I could do is I could see kind of like currently with its current portfolio set up, I could find out what the payoff is at 100. I know 100 is where the highest point will have to occur just because I know the shape of it. So I could kind of ask myself like, well, what is the payoff of this at 100? So I'm going to kind of even write that. What is the payoff of this at a spot price of 100? But that's kind of what we did in that first problem, right? We actually computed it really quick. We're like, oh, okay, portfolio payoff, cost, they all have the same sign pattern and stuff. So I'm going to kind of use that as a tool right now. I'm not really looking for payoff. I'm not trying to do this final question payoff. I just kind of want to know quickly, what is the payoff at the highest price? If it's right at 120, oh, that'd be awesome. But if it's not, I might just have to scale it. No problem. So what I'm going to do is I'm just going to kind of like do some sort of like use my payoff thing as a tool. So I'm going to do plus 3 of the first puts, -5 of the second, +2 of the last one. And I'm going to think if the stock price is 100, which of these is going to pay? So I'm going to think back to the put thing, like, oh, okay, a put would love the price to go down. Did it? Okay, well, so this one wants the price to go below 90. Well, if the price was 100, did it? And you're like, nah, it didn't. So that one pays 0. This one wants the price to go below 100. Since it's a put, did it? No, so that one pays nothing. But this one, the one at 115, it wants the price to go below 100, and it did. Or sorry, below 115, and it did. They all want to go below their own strike. So, and this one did. So each of those is going to pay 15. So actually, this combination, as we currently see it with the green, actually the top payoff is 30. So, oh, okay, I guess it was actually this way. So the green combination will pay off anything from 0 to 30. So this is where we're like, oh, okay, now they want me to scale this now so that it's not going to have 0 to 30, but 0 to 120. So I guess I'm going to have to magnify it by like 4. Right? So that's what I'm going to do. I'm actually going to take this whole thing and I'm going to multiply it by 4. So the real legitimate portfolio that I have is plus 12 puts it 90, minus 20 puts it 100, plus 8 puts it 115. So that's now just to satisfy this criteria about the maximum. Oops, sorry. The max and the min, the maximum payoff being 120, the minimum being 0. To satisfy that thing, I guess I need like 4 of those. And that will now give me this sort of maximum and minimum payoff to be what they said. Okay, so we just had to kind of like work that somehow. The other thing you could have done, by the way, is you didn't have to necessarily do the payoff, what we did here in the red. You didn't have to do that if you don't want to. You could have found it some other way. You could have, kind of maybe made a chart or thought about like what was the slope on that. You could have kind of done it through that way and then found the slope. But yeah, I think this was probably the quickest what we did in red. But we had to somehow see how it was scaled. So that was just one way we could do that. But since I want profit, why don't I do payoff, cost, and all of that satisfies, it's the same as the portfolio. So I'm going to have cost now is plus 12 of how much of the puts at 90s, minus 20 puts at 100, and plus 8 puts at 115. And I could just put all these prices in there. So I've got the 90, so 375, 650, and 1233. And let's compute that out. And I got 1364. So let me know if you didn't get that or if you got something different. Okay. So now I can do my profit. So let me compute the payoff. And then once I do payoff, I'll do payoff minus future value of the cost, and we're done. So payoff. So now I'm going to go answer the question. What if the spot price was 97? Now what's my payoff? So maybe I'll put a payoff and then like, okay, I'll just put ST equals 97 here. So payoff is plus 12 of the first one, minus 20 of the second one, plus 8 of the third one. And I just need to know each of these puts, they're each hoping that the price goes below their strike. So with a spot price of 97, where am I at? Well, how about this? Put it 90. Well, I would love the price to go below 90, but it didn't. So that one's a 0. The put it 100, love the price to go below 100, did it? Yeah, it was 97. Awesome. So each of those is going to pay 3. Then the last one would love the price to go below 115. Did it? Yeah, the price was 97. Awesome. So each of those is going to pay what? 18. Okay. And no shame in having to do it on the calculator. Please don't. Like, just feel free to use the calculator as much as possible. So yeah, calculate out this payoff, and that payoff turned out to be 84. That's what I got anyway. If you got something different, let me know. So then, great. The profit is 84 minus the future value of the cost. So the cost was 1364. But then the future value of it, so now I've got to do this interest. They said something a little bit weird. They said the T-year effective rate. So I don't know, maybe if this is like a 2-year, it's all 2 years in one chunk is 16% or whatever, but that's okay. It's an effective rate. So we're just going to multiply by 1.16. I don't have to raise it to the T because it's not the annual rate for T years, but just the T-year rate altogether. And for this, I got 68.18. All right, so man, we just did a ton of stuff there, right? We did a lot of stuff and put a lot of these things all into the same problem, but it was actually pretty natural. We were able to have this stuff work for us, which was really great. Any questions about that question there?
Yeah, can you frame the steps? Because I feel like we did a lot of things.
For sure, for sure. So good.
So,
Yeah.
and you understand what I mean by frame? Like, first you figured this, like the
Good. So
how you start to how you.
for sure. So our first objective is to find this. So our first ultimate objective is to find what's the portfolio that they're describing in paragraph 1. Now we did that with a couple of sub-steps, but that was kind of like our first ultimate objective. They're like, oh, they told us he had this symmetric butterfly or asymmetric butterfly. They told us what the payoffs were between 0 and 120. So, okay, how many of each put did we need? That's our first goal. So the way that we did that is we used our knowledge of what butterflies were, and we knew that, like, okay, we know the general shape. It looks like this, and we know the proportion of puts that will create that basic shape, but we just needed to know, well, exactly what were the right coefficients we needed. So to do that, we wrote basically what like each of those butterflies looks like. They're like basically in this proportion, 3 of the first to 5 of the middle to 2 of the big ones. But we just needed to know, like, okay, well, from that, where do we what is the exact scaling that we need? So to do that, then we found from there, we're like, okay, I know this is basically the right proportion of things, the 3 to 5 to 2. I know that's the right proportion. Exactly what would I need to scale those as? So to do that, we can try to do it in a bunch of different ways. You could actually have graphed this and then found out from there that it was actually at a height of a 30. That would have been totally fine. In fact, I probably think that might be what I would have done initially. But I thought to kind of pull a little different hammer at it. And I said, like, okay, why don't we know the highest point here will be the maximum. So why don't we find out what actually is the highest point with this sort of like green portfolio that we came up with? So we just found the payoff and found out the payoff at that highest point was 30. So that told us that our initial go at the portfolio wasn't totally right, but it was pretty close. Our initial go was an asymmetric butterfly that had a payoff of up to 0 to 30. So to satisfy this whole payoff of 0 to 120, we needed to scale it by 4. Okay, so all of that was in an effort to get to what the actual payoff, the portfolio is. And I think that's the hardest part with this whole problem, is finding out that initial portfolio. Okay, so here was the steps we did to get there. we first drew the general shape of the asymmetric butterfly, found a ratio of coefficients for the portfolio, and then found out what the payoff would be for that particular ratio of coefficients. We found out it wasn't exactly right, so we scaled it to be right. And that's what we got here. That's how we got to that step. And then once we're there, now it's all pretty easy sailing. It's kind of what we did before. We're like, oh, let's just find out then the cost and find out the payoff, and then we got the profit. Okay, but the bulk of this problem was, what exactly is the portfolio they're talking about? And that's what we spent most of our time with on here. Did that answer it? So sorry.
No, that was perfect. I appreciate you walking through.
Okay, sounds good. Yeah, but it's like, it's one of these where it's like, it's kind of subtle. Like, why do we even have to do this? You know, like why do we even have to like check this part out? And it's like, oh yeah, just because you have one set of coefficients doesn't mean it's the exact shape. It's similar, but it's like, it might need to be scaled. And so that might have been part of the problem on this one, is like, why do we even need to do that? But yeah, that's it. So, oh, good. Yeah, good. Thanks. All right. Well, let's keep on going then, and let's hit some things about the forwards and synthetic forwards and arbitrage, and then we'll talk about futures and just a couple of things after that, and then we're finished. I'm gonna take it like just a couple minute break though. Why don't you refresh, and why don't we do that? Let's take maybe 3-4 minutes, something like that, and we'll come on back. Okay, so let's talk now about another aspect of things, forwards and futures, and talking about those. And we'll try to get back to that aspect of like how these relate to like the stock and things like that. That'll come up here now in this part. So first of all, a forward contract. It's good to understand exactly what these are, because tomorrow we're going to be talking about prepaid forwards. And it turns out that those are like actually probably the most important thing we'll talk about in these seminars for this in like kind of in a conceptual way, but also from a practical way. It'd be super important. So it's important for us to understand what a forward is first, and then we can talk about prepaid forwards too. Okay. But they'll go hand in hand with each other. But basically what a forward is so FT little t, capital T, X. It's just a notation, but it's just basically saying if you're standing at time little t, it's the price that you would expect to pay. Since it's a forward, you're going to pay it later. So you're going to pay it at time capital T. You're going to pay it at the end. And you want to receive what? Well, you want to receive exactly one X, whatever it is, because that's what they're after here. You want to receive exactly one X. Exactly one X, whatever it is. And we're going to find out that we're going to do some pretty trippy stuff. We're going to not just talk about stocks, we're going to talk about other weird things. Okay. But you want to receive exactly one X also at time capital T. But it's going to be all based on the information that you have at time little t. Okay, so you're just going to use the information you have here, but you're trying to make a guess as to how much you're going to have to spend here to receive exactly one X at that time. So it's all in the forward. It's like you're not going to pay anything at the beginning. That's why they say forwards have like zero premium. You're not going to do anything at time zero, but you're going to pay everything at the end, but you're just trying to like shoot for the price that you'd expect to pay then. Okay. So, and you kind of memorize these formulas. So basically, if you're at time zero, you realize that, yeah, here were the formulas that you've had before. We'll talk about these a little bit more tomorrow, but probably you just remember these formulas for now. That's okay. It turns out that forward and prepaid forward are related pretty easily, but we'll also talk about that in the next seminar. Anybody not have these memorized or whatever? I think these are pretty important. Tomorrow we'll talk about how to know them without memorizing, which is actually good, and maybe even a better way to kind of even think of them. Okay. but we're just going to need them for today. So I just wanted to put them on here just for completeness. But notice how they all kind of like, if I'm actually at time zero, they're all going to be based off of the current price of the stock. So that's just kind of a good thing to know. All right. So a synthetic forward, and now we're going to start getting into the arbitrage situation and kind of like how we're going to try to handle that. But arbitrage is really all related to this idea, like we said before, that kind of everything is connected in the market. So if something's not priced right, it's probably affected by something else, or maybe you can kind of take advantage of that mispricing because there's all these connections. So if you're real clever, you can find a way to create the same sort of thing, but using other objects. So you're going to kind of like mimic exactly what the thing that you would want to do is, but you're going to do it with other things so that maybe through those things you have the correct price, but then you have the price that's not correct somewhere else. And so then you can kind of like go long in one, short in the other. You can kind of counteract them, and then you're just going to be making the difference. That's one way to exploit arbitrage. So an important thing to be able to know what to do is to, how can I create something synthetically? So how can I kind of like mimic the exact same thing as something else, but with other stuff? And with a lot of arbitrage, that's half the battle, or that's most of the battle, is just what combination of these other things do I use to construct it? So you've probably heard of synthetic forwards, and it's just a different way to create a forward contract. I remember hearing synthetic forwards in two different contexts. One was with the calls and puts. So I'll do that one first. Sorry, I should have probably put that first. But when you're learning about these, they talk about like, oh, a synthetic forward you can make with a call and a put. And we can probably see how to sort of do this with by deconstructing the graph. And we see like, oh, okay, basically it looks like a call here. And it looks like a long call. But then I'd also need sort of like this this part here. So I guess that looks like a short put. And they might tell you that, yeah, a forward you can create synthetically with a plus call minus a put, a call C minus P. And that's one way to synthetically create a forward. And these would have to have the same strike as the forward price. So the strike would be the forward price in order to create this as a payoff. Now, if the strike is ever different, then we kind of need to shift things. And that's actually where put call parity comes from. In fact, you might look at this and be like, hey, that kind of looks in a weird way like put call parity. Call minus put equals, well, actually it's the prepaid forward minus the stock, or like the present value of the bond, or the present value of the strike. So like some of the details might be a little different, but this is actually reminiscent of that, where it's kind of like, oh yeah, so this is that idea. The thing is here, this is actually a payoff. So this is something in the future. These are all payoff graphs, and we kind of constructed it from that. But put call parity is a time zero thing. So that's why the details are a little different. But we won't worry so much about that. We just kind of want to know the general idea that yes, if they ask me for how to create like some sort of arbitrage opportunity with a forward calls and puts, I would probably think of this equation here. Okay, and the one that was asked about a little bit before, but what about a forward, a stock, a forward and a stock? And it turns out that, well, we saw before that if I'm trying to replicate a long forward, it looks basically like a long stock. Except that I guess I would need to shift this down. So in order to do that, I'd actually have to combine it with like some sort of negative bond, with a short bond. So it turns out that I could use a long stock, but then I would have to subtract a bond from there. So this is a really important equation. Forward equals S minus B. This is at the heart of this idea about cash and carry arbitrages, where they'll say, oh, you got this forward, it's a mispriced, but how would I do that? How many shares of stock and how much should I spend on a bond? How much should I lend or borrow in order to receive or like to exploit that arbitrage? Well, it's all going to be related back to this. Okay, in a question like that, if they said how many shares of stock and how many bonds would I need to do it? Okay, and again, this is kind of like a time t equation. So we are going to be kind of interested in time zero, but the nice thing is that the bond sort of will help us with that. Because remember, actually for profit, the bond will actually wash out. And so if we talked about the profit for a forward and the profit for a stock, those should kind of be the same. But for payoffs and the bond will just kind of help with some of the details, that's all. But this is the idea where this is the connection. Oh, I also wanted to mention here too, what does it mean to have a short bond? Like, does that mean that you're borrowing money or lending money? So that's something that we just want to kind of address now, because we're going to see this later. And if it's for me, I'm always going to have like portfolio. If my portfolio equals plus B versus if my portfolio has a minus bond, right? So long and short, what does it mean? Which one's the lending and which one's borrowing? Because that's all it is like, oh, you just like, you purchase a bond or you sell a bond. So you're either like borrowing or lending or something, right?
Are
So
you
they might just
lending?
I'm sorry, what's that? Oh, sorry. So that's the big question. We just want to know, like, okay, which one is lending and which one's borrowing? Because they might not say like long or short bond, but they might say how much do you lend or how much do you borrow? So we just kind of want to know that for us. So what about a long bond? What do you think that is? Is that borrowing or lending?
You're borrowing because you're giving out money.
Okay, good, right? So we want to kind of think of that. So we think of a long, right? And this is going to be too much thinking to do. That's why we want to kind of like come up with a kind of a good way for us to know here. But okay, it's a long bond. So we can think of like a long stock. What would we have to do at time zero? We would have to purchase it. So we're going to spend money at time zero, but then we're going to get back money later. So we're going to give money away now. So what is that? Borrowing or lending? And it turns out that long is lend. But to me, I'm like, I would always sort of think about that wrong, or it would like took too long, or I would just kind of like, to me, it always felt like borrowing too. So I totally feel like you. So, but for me, for us, whenever we're talking about a portfolio, long is lend, L with L. That's how I'm going to always think of it. And minus is borrow. Now, why? How could we sort of reason on it? Like, well, what does it mean to short a stock? Well, that means you're going to, receive the money for the stock right away and then have to pay it back later. So you receive money early and pay it back later. That means you're borrowing money, right? So it kind of makes sense, but it's just like, it's always one of those where it's like, maybe it's this, maybe it's that. But for us, if we ever use the portfolio method, a plus is long as lend. Now, if you did cash flows, so this is the thing that kind of gets confusing because some do cash flows, some do portfolio, some do both and they don't tell you. So you got to know. But as a cash flow, if I had a plus bond, that means I would receive the money, right? It's a positive cash flow for me. So I'm borrowing, right? So we just have to be a little bit careful. As long as you know which one you're doing, just be careful. You still are short in this if it's a positive cash flow. And that's the thing I feel like is a little confusing. That's why I kind of like to simplify, just keep it to portfolio, long as lend, we're good, and we're done. Okay. But we're going to need that for these cash and carry because they're pretty, they're pretty picky about it sometimes. So, okay. But the big thing is here, and the nice thing is that if you ever forget this, you can actually just kind of redo exactly what I did here. Super easy. Like you can do it in 2 seconds, seriously. So you don't even really need to memorize this, but just know that, oh yeah, there is some connection between a forward stock and bond, and you can just kind of redraw it if you need it. Okay, I'm one where I'm like, I don't really want a lot of formulas, and I'm hoping to help you to like such you don't have so many to memorize either, as long as you're understanding all these things, right? So that's going to be my goal, is to try to help minimize the formulas that you have to memorize. So let's talk about cash and carry arbitrage. So we're gonna cash and carry always has this idea about you're gonna like, you know, cash in and buy some stock and then carry it to the end or something, or like it has that idea. It's always going to be a forward, a stock, and a bond, borrowing or lending money. So we're always going to get back to that forward equals stock minus bond. We're always going to kind of come back to that for cash and carry arbitrage. Okay. And so what cash and carry is where, well, you kind of want to think of like the cash and carry or reverse based off of what you're going to do to the stock. Are you long in the stock? Long in the stock is a regular cash and carry, and reversing would be where you're short in the stock. Okay, so we'll talk about that specifically, but to me, that's how you can always tell if it's a regular or reverse. Look at the stock. If it feels normal, like long, then it's a normal cash and carry. If it feels backwards, short, it's a reverse. And you can think of it always in point of view in terms of the stock that you're going to be dealing with. Okay, but here's what a cash and carry is where the prices for a forward are not the same. You can actually, like, maybe there's some forward price out there that's like 80, but then you compute what the forward price should be, and maybe it's 90. And so you're going to go long in one, short in the other. And when we do this, we know that the slopes counteract. I'm going to get something flat. And then in this case, I'm going to end up with a profit that's completely above the axis. So that would be where it's violating arbitrage, which is what they're trying to exploit here. Okay, so it's where the real forward price, or the forward price that's kind of out in the market that they're offering, doesn't match the price that you should compute based off of those formulas that we had. And if the prices are different, I can recreate the theoretical price using other stuff. I'm going to create that one synthetically. And then that's the one that I'm going to kind of counteract the other forward. I kind of like, here's what the price should be, but here's what the price is. And I can kind of go long in one, short the other, and counteract and just get like a pure profit. That's what the arbitrage is going to do. So the way that we're going to do that, well, with stocks and bonds, is we're going to, for a cash and carry, you borrow the money and you're going to buy the stock and you're just carrying it. So you're like, oh, give me some money. I'm going to borrow some, buy some stock. You're going to carry that stock with you all the way to the end. That's where the name comes from, cash and carry. Give me some cash. I'm going to carry the stock. And then a reverse would, I don't know, be, I guess, where you short the stock and you use the money and lend it out, but it just doesn't feel like it's cool. So, but okay, well, how do we know when to do it? Well, we're going to do a cash and carry if the market forward price, so the one that's kind of just out there in the market, they can put whatever price they want on it. So somebody mispriced it, but it turns out that the forward price is higher than the price that you compute out theoretically. You use the formula for. And if you use the formula for it, then you can create it using other stuff, because everything's all hooked together. So everything should have like kind of be connected with that price. You can make that same price with other stuff as long as that stuff's priced okay. But the thing you're exploiting is the mispricing of the forward, right? So what we're going to do is we're going to say, okay, the market forward out there, so that's what the forward price currently is, but that's greater than the theoretical price. And the theoretical price, I'm going to actually compute out with other stuff. So I'm going to put that here. So that would be where we observe that the price that's offered is higher than the price that we compute synthetically. We can recreate it, and we got that. Now, here's where I'm going to show you another way to do it. You've probably done this a different way, but I'm going to show you another way, not to confuse you, but just to complement what you've learned. That's all, just to try to help to, just so that you can kind of see what's happening. But what a lot of learning platforms do is they say, okay, once you have this, here's the right equation that you observe. So we observe this thing, and they say move everything over to the greater than sign. Okay. Now, I'm going to say to do the opposite. Okay, just bear with me, but just for like illustrating purposes, I actually will always move it to the opposite, but you can still move it to the greater than sign if that's what you're comfortable. I know the test is just in a couple of weeks, so you don't want to change up a bunch of stuff, but I think it's good, valuable just to see the difference so that you can kind of just to understand what they're doing better. But I'm going to say, I'm going to move it, everything to let the arrow point the way of the inequality. And I'm going to say, move everything to the less than sign. So I'm going to have 0 greater than negative f plus s minus b. The reason I do this is because this then is exactly the equation of the portfolio that you're going to need. And it's super easy to see that I'm going to have to go long in the stock, short in the bond in the forward. Because plus is long, minus is short. And for me, this is like super easy to see. Okay, I'll show you what they do. A lot of times they move it over to the other side. Oh, sorry, one last thing here too. The reason why I like this is because the portfolio thing, but cost follows the same sign pattern, and cost will be negative. This is the only part that's a little weird to think about, but a negative cost. So if it costs me a positive $5, that means I gotta spend $5 for it. But if it costs me a negative $5, that means I'm going to get $5. That's kind of a good situation to be in for arbitrage. You make money right away, right? So I would want a negative cost. But what they do is they kind of think of it from cash flow point of view. And remember, we said cost and cash flow are negatives. So they're going to move it all over to the other side. So they're going to say, oh, plus F minus S plus B greater than 0. And then they're going to say, here's my cash flows. This is the recipe, but it's not the portfolio. This is like the cash flow equation. But the cash flow is like kind of like negative of the cost. So that's why we got the opposite sides, right? Because I'm doing cost, they're doing cash flow, and those are negatives. But they're like, oh, cash flow. So you're like, oh, I'm gonna have to do plus for forward. That means I'm gonna have to positive cash flow. It means, oh, that means I get it. So because I got a positive cash, it's kind of like I'm shorting it. So I'm gonna get a short forward. And then minus the stock, oh, I'm gonna have a negative cash flow. I'm paying for it. That means I'm going to buy it. So I'm going to buy the stock. And then a plus for the bond means well, plus positive cash flow. I receive money. I guess that means I'm borrowing. So, but to me, I'm like, I feel like that's too much thinking. It's the same thing. We got the same answer. We got that. Remember, long is lend, short is borrow. So I'm still borrowing money to do it. But I still got the same final result. I just feel like the cash flow thing, I mean, it's fine, you could do it. I just feel like that's like kind of a lot of thinking to do. So, but if you're kind of comfortable with it already, keep it, no problem. I'll do it with the cash or with the portfolio thing, just to kind of give you maybe another thing to look at. But feel free, if you're comfortable with cash flows, just keep it like that, no problem. It's also no harm in changing it up. If you kind of like the other way better, you won't have a lot of support probably with their solutions, but you can just kind of remember like, oh yeah, they're doing cash flows, I'll do portfolios. So it'd be negative, but the final result's the same. And it's not too bad. So do what you want. I'll probably say this probably like with all of them. I'll say like, oh, if you did it the other way, here's what you'd get. But I just love how simple this is. And I think that's kind of a good thing to know about, like if it's that simple. So, okay. But anyway, so that's what you do for, and this is the right recipe because here I am actually borrowing the money, long is lend. So short is borrowing money. And then to go long in the stock where I'm buying the stock. So I'm going to actually borrow money and buy the stock. So that's actually where we see that this recipe is the perfect one for cash and carry. And reversing cash carry obviously will just be everything's opposite, but that'll be where the market forward has a price that's lower than what it should be. So the forward will be less than, and then the price that we'll compute out. So the price we compute out, then we can create synthetically. So we're going to do S minus B. And if you do like the platforms, they'll move everything to the greater than sign and then do a cash flow thing. I'm going to move everything to the left less than sign. So I'm going to have a positive F minus S plus B less than 0. Here's my portfolio. So I'm going to have to go long forward, short stock, and plus bond. Long is lend money to do it. Okay, so same thing. If you did cash flows, you'd get the same things. Every sign would be negative, but you'd end up with the same final result. Just one less thing to kind of think of. And again, I'm not trying to make you like change things up at the last minute, and try to just give you one more thing to think of, but It's kind of good to see the difference, just to see why they're doing what they're doing. That's all. Sometimes contrasts are good too. Okay. And then it's like, honestly, then now you have a second tool to use on these too. So you can think of it like that. Okay. All right, well, let's see how this would go here. So we've got a stock with a current price of 80. It has continuous dividends, 3%. Okay, so the dividends is 3%. Delta is 0.03. Continuously compounded risk-free rate is 5%. R is 0.05. In the market, there's a 2-year forward with a forward price of 82. Okay, so that's, we would just denote it F02 of stock is 82. Okay, no problem. Okay, then just as I was looking at this earlier, I just kind of want to make it just a little bit more clear, but for each forward contract, a zero cost arbitrage opportunity can be exploited by either buying or selling a certain amount of shares of stock and borrowing or lending a certain amount of money. Okay, so they just want to know how much should you either buy or sell, how many shares buy or sell, and then how much money do you borrow or lend. Okay, so just, it's pretty good, pretty routine question, but let's kind of see how we can use what we know to be able to do it. And these always have this one important little subtlety that I want you to know about, that we actually have already talked about, but I want you to see it here and see why it's the case. Okay. So, okay, well, let's do what we do. Okay, first thing we find is so they told us the forward price, but what should it be theoretically? That's what we want to do. So I'm going to say here the theoretical price. Well, here's where we could use those formulas, and it was current stock price e to the r minus delta, 0.05 minus 0.03 times time. All right, let's see. Yeah, let's see what we get here. Okay, and I got 83.26-ish. Okay. So 83.26, and okay, the prices are different. Okay, so what do I do? Well, this is the theoretical or synthetic, like this is gonna be like the synthetic part, because this is the theoretical price. If everything in the market's good, I should be able to recreate this some other way. So I'm gonna be able to kind of like create a fake forward to sort of counteract this forward that's out there. So I look and I first say like, oh, let me see what I observe. I observe that the real forward price, that's the 82, or market forward, is actually less than the theoretical. So the market forward is less than the theoretical price. And this is the one that I'm going to create with stock minus bond. Okay, because that's the theoretical. So this would be, is this the cash and carry or reverse? Well, we would actually know that a little bit more once we do our next step, but we can think back, and that's actually this kind, the one where the market forward. So this is actually a reverse cash and carry. Now we're noticing that the forward price is a little bit low. It's a little too low for this. So, okay, well, so that's good. So I'm actually going to erase the M, but it is that the market for the forward that's out there in the market is too low. It's below the stock minus below the theoretical one that I can create synthetically. So for me, what I'm going to do is I'm going to actually, move everything over to the less than sign, and that's going to give me my portfolio. So my portfolio is going to be basically plus F minus S plus B. And that's going to be 0 or less than 0. Okay, but we don't need to write that because we're just going to move everything. So this tells me basically, I know for sure right now that I'm going to actually have to short the stock. So I'm going to have to actually sell a certain number of shares of stock, and without even knowing anything, I'm going to have to sell a certain number, and I'm going to go long is lend. So I'm going to have to lend money. So I actually know those two parts immediately. And honestly, if you're on a test and it's at the end, you don't have much time, you could probably eliminate half the choices just from that. Okay, but we're going to go through the details and find out exactly how many shares and what we're going to need. Now, here's the subtlety that's important. So this is a portfolio. So this is at time zero. And the arbitrage is, or the payoff is going to be important because that's the thing where hopefully if I were to like receive money at time zero, as long as in the future I don't have to pay a bunch of money, I can maybe pay some as long as it's not more than how much I got originally. This case, they're actually wanting a zero cost. So I'm going to try to find the right combination of stuff, but so that it's going to cost me nothing. And then later, then hopefully I'm going to have just a positive payout only or zero and positive. And so I can actually just get my money at that point. Okay. But the thing is I'm going to have exactly one forward contract, which is going to end up with exactly like, is going to take whatever exactly one share of stock is at that time and kind of use that because it's like the price per share of stock, right? That's what the forward price is. But the problem is here that if I were to short one share of stock at time zero, remember what we talked about earlier, when I talk about the payoff, I'm not going to have exactly one share of stock there. I'm going to end up with more than one share of stock. So this is going to grow into more than one share of stock, but the forward is going to talk about for each share of stock. So there's going to be a little bit of a mismatch there. What I'd really like to do is I'd like the stocks that I buy to actually grow into exactly one share to completely offset the thing from the forward. Because the forward is only talking about one share of stock, and I want to end up with exactly one share of stock at the end to sort of cancel it out. So this is where we're going to actually not purchase exactly one share or short one share of stock, but we're going to have to tail it, and we're actually going to have to do, so I'm going to have e to the negative delta t shares of stock here so that it's going to exactly grow into one later. Okay, and you can look later at the payoff. I'll leave that for homework too. Let's see why that's the case when it comes to this forward contract here. Okay, but that's the little kind of subtlety that they don't really tell you. Even the other platforms, they'll all have to address this somehow. But just keep in mind that the problem is that the forward contract is really dealing with one share of stock, but this is growing into more than one share, and then it's just not going to be like, it's not going to be able to cancel out all the risk. There's still going to be like this weird extra part of a share of stock out there somewhere that you're not going to be able to account for. So we will get around that by sort of adjusting our portfolio. So actually, let me call it, here's the real portfolio we're going to need. I'll go forward minus SE to the negative 0.03 times 2 plus some sort of bond. And by the way, this then is the number of shares of stock that I'm going to want to short. So that's actually X. X is equal to e to the negative 0.03 times 2. Point 9417, 6, whatever. So 0.94 probably would be all they'd put on there. But so you would want to sell or short 0.97 shares of stock, because then over the 2 years, it'll accumulate more shares exactly to exactly one share at the end. Okay. And that's why they do it. And it's just because like there'd be some sort of like weird imbalance at the end. Okay. So that actually is X. X is this, and I would need to sell or short 0.97 shares of stock. Okay, and then now we just need to know, well, how much bond would we need to buy or sell, like borrow or lend to do that? But actually, it's gonna be super easy with this whole portfolio, cost, payoff, all being the same signs, because now my cost equation is going to be plus for the forward, minus for the stock, e to the negative 0.03 times 2, plus the bond. Actually, that's what I'm trying to find out, but I actually want zero cost. So this is super easy. I'm just going to let that equal 0. And I'm just going to let the math find out this stuff for me. All right, we're trying to find the B, so that's why I kind of left it there. But here, how much would each forward cost? And like we said, forwards are actually should cost 0. How much would a stock cost? Well, each stock costs 80. But again, I'm going to end up purchasing a little bit less than a share, so that's okay, no problem. And this will actually help me to find B. In fact, I guess B is really just going to be adding that 80 times e to the negative 0.03, so times 80. So negative 7534 plus B equals 0. So B equals 7534. So now I know why. I guess I'm going to have to go long with $75.34. So I would need to lend 75.34. That's my why. Okay. And that's it. So maybe a good assignment would be try to write out what you think would be the payoff for this. Okay, so maybe do that a little bit later because we got to move on now. But the payoff, and you'll see that the payoff should equal some positive constant, exactly a certain amount of money. And in fact, it'll probably be actually the difference between these, $1.26. So hopefully that will be the what you get when you kind of do the payoff equation, because the profit will be the same, right? Because the cost is 0, so minus future value of the cost, the payoff will equal the profit. Okay. All right, we just got a couple more things here, so this will go a little bit long today. I apologize, but yeah, I just want to talk about futures, just one question, and then hedging stuff just for a minute about that. But the futures question, I kind of want to make a little bit complicated, just so that you could see a little bit of maybe the way to think about that. Okay. I just want to talk about futures sort of in general first. And you might have seen this kind of comparison here between futures and forwards, but it'll be an important concept later that when we talk about futures trees or like binomial trees with futures contracts, we're going to kind of think of it like a forward anyway. And we just want to kind of see what it would mean here. But the difference between a forward contract and a futures contract, they're both some sort of bet about the future. They're both about some sort of underlying asset. A forward contract, though, is like, it's just a contract that you can make with anybody that you want over anything that you want. So it's super general. And so, so you can kind of make it however you want to. Okay. A futures is something much more standardized. They're ones that you kind of buy in the market. You kind of like, they'll have a certain set expiration date, but you can kind of like, yeah, they're just like much more standardized. Okay. But the big difference between them is like a forward contract is super risky, because what you're doing is you're just kind of making a contract with somebody for like maybe 2 years out, and you're not going to pay anything until that 2 years is up. And honestly, a lot can happen in 2 years. And we saw with the pandemic and stuff, like so many companies could go under or whatever. So a forward contract is like really risky because of the time involved. So what a futures contract does is it says like, okay, each day we're going to kind of track the progress, and we're going to kind of update the prices and update our accounts every day or every week or whatever it is, in so that we can just make sure that once we start to kind of veer out of control, we can leave the contract or whatever. Okay, so they kind of manage the risk a little bit better. So that's what they call being marked to market. Every day or every week, they kind of update sort of your situation and kind of reflect it to the new reality of what they have there. Forward contracts are much riskier because they don't do that. They just leave this like 2-year gap, and like hopefully you got enough money at the end to do it. Forward contracts you can customize with whoever you want over whatever you want, but futures are much more standardized over just certain things like the Dow Jones futures and stuff like that. But you could have forward contracts on like gasoline or pianos or whatever. I mean, whatever, you could just do anything. Futures are traded in the open market, but forwards are, you have to find like a specific person just for you and your situation. Forward contracts, you're stuck until the end, but futures you can actually leave by just taking the opposite position. So if you're long in it, you can just enter another one where you're short in it, and that essentially cancels you out. And then you've probably seen these terms here, the notional amount, margin, maintenance. So a notional amount is like, well, there's some amount of money that all this is really dealing with. So how much money is the contract really over? That's the notional amount. A margin is kind of like this. You can think of a margin account, which is like sort of this other account where you have to put some money in because every day they're going to track the progress. So you could either owe or, gain money, but they don't want to have to call you every day. So you kind of just have to put a little buffer money in there. That's the margin. Maintenance margin is actually just a level, like a threshold where if you go below that, that's like too little money for them to be comfortable with. So that's the amount of money that has to be in your margin count. And then if it ever dips below that, they're going to do a margin call. And that's where they're going to call you to make sure that you replenish your margin back up to, well, the original margin amount. Not the maintenance margin, which is that sort of threshold. They're not going to make you replenish it just up to that, because then if you have like one more bad day, now they got to do it again. So they're going to kind of make you go back to the original. That way they kind of go back to have some buffer around it. So, all right, so let's do a question on this. Okay, it was just kind of a lot of terminology, just like sort of like information overload on these questions, but I'm going to kind of play around with it. It's okay. But there's one important thing that there's been a lot of sort of controversy over over the years, as I've worked with students, and even with some of the platforms, they've sort of changed how they did things because it wasn't right. So I'll kind of point that out as we go. But okay, so we have got a stock index has a current price of 500 and pays continuous dividends at 2%. And now they're looking at this like 26-week futures contract. Okay. Has a multiplier of 200. So we'll talk about what that is. Settled weekly. So this is marked to market weekly. And needs a 10% margin, has a maintenance margin. That's 70% of the initial. The margin account earns a certain interest rate. Oh yeah, so that's the other thing too, is that if you have this margin account, you kind of have to give them this money. You're not paying for the contract or anything, but you have to sort of put this money in some other account so that they can add or subtract to it. But because it's like you're kind of just giving them money, you should sort of earn interest on it. So they'll often have you earning interest on the margin account. All right, and then, okay, you enter into 8 short futures contracts, and if the index price in 1 week is 520, determine the value of the margin call. Okay, so again, if we were short, you're hoping the price goes down, but in this case, the price went up, so it must have been a big loss for you, so that's going to deduct from your margin account, and so they're going to perform a margin call. So, all right, well, let's get into this then. Sorry, let me just make this one a little bit bigger. Okay. Okay, so first things first is we need to talk about our notional amount. So the notional amount is just going to be, well, the total amount of money that we're dealing with. So we're going over 8 contracts. So it's going to be 8 times. And then each of them has a multiplier of 200, they said. So this is a real common thing you'll see, 200. That just means that like, okay, they're just going to have this like, it's kind of over 200 shares of stock or whatever. That's all it is. But then times the price. Now, here's been the controversy. Some people have been like, oh, why don't we just put the 500 in there? But that's actually not the price that you want. The price that it really should be based of it is the futures price. This is kind of like, they're talking about the stock index, but you could think of that like a stock kind of. But this is kind of like the stock price, but you actually want the futures price. That's what it should be based off of. So this should really be the futures price. And remember, the futures is a forward, so this is actually the forward price. So we really want to know what's the forward price. So 0 to 26 weeks. So sometimes I just write it like that on a share of stock. So I'll go 26W. I don't know if you can see that or not. So you could do 26 over 52 there, whatever, however you can communicate that to yourself. But here's where we actually need to use the forward price formula. So it's going to be current price times e to the r minus delta, 0.04 minus 0.02 times 26/52. And here I'm going to use a feature of the calculator. If you're using the same one I am, then it'll go good. If you're using the other one, this is the other big one that people use, the TI 32S. That's fine. You can use that one too. Oh, you could even use this one. I've had some people use this one, the BA2 Plus. You could use that one too. But in all these, you want to kind of use the same sort of feature to be able to keep things straight here. Okay, so let's compute this out, and whichever one you're using, I'll show you the feature that I'm talking about. So 500 times e to the 0.04 minus 0.02 times 26/52, and I got 505,025, whatever. So the feature that I'm talking about is storing values. So I'm going to store this into, well, if I'm on that calculator, I'm going to use X. So the TI-30 XS, I'm going to store it into X. Now, the way that you do that, hopefully you're using this already, but if you're not, oh, start, because this is a lifesaver. So if you can't, write down at the bottom under by the on button. Actually, if you're using the other TI-30, you can also see it there too. But right above that, it says like a stow with an arrow. So hit that, and then the button right above it should have the variables. And I think if you're on this one, you get X, Y, Z, T, A, B, C. You got like 7 variables you can store it into. You can also scroll back up. That's okay too, but this is sometimes more handy. We're gonna kind of want that here. So I'm going to store that into X. And for me, when I do that, I kind of put on my paper a little arrow and an X with a box around it so that I can clearly see what's in my calculator and what's not. Now, if you use the other ones, it might be like capital A or something like that. That's fine. Just put a little capital A there instead. And if you're using the BA2 Plus, you can also do that. You can store values. It's slightly different. You just have stow. And then you can actually store into any of the digits, 0, 1, 2, 3, 4, 5, 6, 7, 8, or 9. You can store into any of those. It's just not as like fulfilling in a way because it almost doesn't really show you that you stored anything. So you feel like wrong or like it's not working. So just be careful. But I'm going to use this because then over here, that's the price that I actually want to use for my notional amount. And I'll be able to get that here real easy. So 8 times 200 times X. And then to get X, you just press the X button, super easy. And you can get 808,040.13 whatever. That's fine. Now that number is not going to be super important for us later on, so I'm not going to store that one. But the margin amount will be, and the maintenance margin will be. So I'm gonna store those. But so the initial margin, they said the initial margin is 10%. So I'm gonna call it M0 initial margin. It's just gonna be basically that number times 10%. So hit that times 0.1, super easy. That's the 80804.013. So we already knew that, just moving the decimal place. And I'm gonna store that into Y, or you can store it into something else if you want. I'm gonna actually store a bunch of variables on this just because I know I'm gonna need some of these, but I'm not really sure which ones and where, but feel free to use this. It's actually gonna be really helpful. And then the maintenance margin, so I'll call that MM, maintenance margin is gonna be 70% of that. So I'm gonna have, I guess, that number, Y, times 0.7. So times 0.7 stored into Z. So 56,562.8. We'll store that into Z. All right, so we've got that. So we've got all these numbers here. Like, again, we can scroll up to it, but there's just going to be a lot of things. It's kind of nice to see it on the paper, and it's quick and easy to just write it. It's super fast to do that. Okay, so now let's see what happens in 1 week. So we got our values. So we're going to have to give them initially $80,000, and over the course of the weeks, it'll kind of go up and down. If it ever goes below 56,000, that's their threshold for too low. Our margin, we'd actually have to like replenish back up to the 80,000, back to the initial if we ever have a bad week. Okay, so let's see what happens in 1 week. In 1 week, well, what do we get here? So our margin in 1 week is going to be, okay, well, we're going to actually get interest on our initial one. So we're going to get our initial margin, which I have in green here, which is Y. So we're going to have Y and then 1 week's worth of interest. So 0.04. And then 1 week's worth was what, 1 over 52, is that right? So I'll just divide it by 52. Okay. But then, okay, well here now, I guess I'm going to be losing some money. And it makes sense because, well, the price of the stock went up. I was short. I'm hoping the price goes down. It's not really these that you care about, but it's the forward prices of those. But probably the forward price also went up too, which, you know, is also bad. So I'm going to say I'm going to minus 8 times 200 times, and I'm going to want now the difference in these prices. Because I know that I'm on 8 futures contracts. Each of them's over 200 shares or whatever. And so I just need to know, like, okay, I know I'm going to be losing money. How much money did I lose? What was the difference of those prices? Okay, so let me find out the new forward price. So now I'm starting in 1 week and ending in 26 weeks. But it's still just a forward price. So I'm going to do the current price. In other words, the price in 1 week. So 520. 520 times e to the 0.04 minus 0.02. But now instead of 26 weeks, that was only 25 weeks left. So 25 over 52. So let's compute that out here. So 520 times e to the 0.0 times 25 over 52. So 525.024. So I'm going to store that into my next variable. So I guess what's the next one? T, is that the right one? Okay, I'm going to store that into T. Okay, super complicated. We could probably do this, you know, by scrolling back up like we said, but just keep it like this because I can easily see the difference now. Like, because I really want to compare the new forward price compared to the old forward price.
What's your answer? Did I put the wrong thing in?
So what's that?
I got 530.
Oh, I'm sorry. What was the price?
I got a different answer.
Oh, you got a different answer? Okay. Anybody else get something other than the 525? Let me just check it out real quick. Sorry about that. So let me know if you got something different. Okay, so 525.024. So maybe what answers did you guys get? Sorry about that. And 25 over 52.
I figured it out. I had 25 over 26, not
Oh, okay.
52.
Oh, perfect. Okay,
Okay.
great, great. Oh, no, perfect. Thanks so much. I appreciate it. Okay, good. So we got that number. And okay, so then what do we need here? Well, we're always going to be looking at here. Well, what was the change? How much did it change? And for here, we're like, oh, okay, I guess the difference in these two is what I want. And I guess it changed by, well, basically about 20. So I'm going to put in here T minus X. And actually this makes it real clear because now I could just go back in and do Y times e to the 0.04 over 52 minus 8 times 200 times parentheses T minus X. And like, that's the hard part about this, is like it swims in all these numbers, but if you kind of write them all out like this, it turns out really nice. And this is going to be equal to 48,867, 74, whatever. So I'll store that into one more. I think probably I don't really need to do too much now, but I'll just store that into A just in case. Okay, so what this means is like, all right, now my new margin account is down to 48,000, which is definitely below the maintenance margin. And what I need to do now is I just need to replenish, and I need to replenish back up to the 80,000. So now what do I need to do? Well, I guess I just need to, the margin call is going to be, I guess, the 80,000 minus this 48,000. So I guess I'm going to have to do what? Y minus A, and that's going to be the margin call. And I got 31,936. That's close enough, right? Okay, but just I thought this was a kind of a good one because it's a kind of complicated question, but like sort of what makes it hard is all these like little numbers, but you can use your calculator to even make that a little bit easier. But I just wanted you to see one forward or futures contract question. We'll talk about futures later, but probably not details like this. We'll just be looking at like calls and puts on futures and using binomial trees and stuff like that. Okay. All right. And then, all right, last question or last kind of topic here is just hedging. And this is actually a real quick one here, but hedging here, what we're going to think of, and this is going to contradict a little bit of something that I said a little earlier, but there's a good reason for it. So, all right, what do we mean by hedging? Well, usually what they're going to do is that you're going to own an asset or be short in an asset, and you want to combine that with something else. But we already know what long in an asset looks like. It looks like this. And just knowing that is going to make it super easy to know what kinds of things are like compatible to combine this with. So for example, this one has a +1 slope everywhere. So I'm probably not going to want to combine it with something with a +1 slope also, because then I'm going to end up with +2 slopes. And I mean, yeah, it's possible, but it just doesn't feel right. So the right things to add to combine with this are things with -1 slopes. So we could talk about a long, well, whatever that one is, what a long put. So plus S plus P. Or you could even talk about a short call plus S minus C. And you could even do a collar. That would also be okay. That's another hedging strategy, but that's also got negative slopes. So there's actually, you could do a lot of things. And this is like kind of that zero cost collar thing. Sometimes if you have a stock, you can find a zero cost collar to combine with it to completely change your payoff structure for free. So it's kind of nice. These two are the ones that we're going to focus on though, just with puts and calls. That's when they talk about the most. But all right, well, what's this going to look like? Well, let's come up with our initial a point here, and I guess it's just going to be whatever I guess K was here. So I'm going to start at K, and then all right, well, I'm going to have a +1 slope. -1 slope is a 0 slope. Positive slope, 0 slope is positive. Okay. And if I wanted profit, it would have to shift it down and down sufficiently far. In fact, this would exactly be the profit for a call, a long call. So if you actually knew how much a long call costs, you could kind of decipher how much this thing would have to shift. Super nice. The profit would have to be that, and it would have to be that as long as this was dealing with all market items. Now we're going to see that that's the thing that's going to be not right, or that's going to be different here, is because sometimes with these, they won't be all market items. Sometimes they're actually going to be things where people manufacture. And so they're going to find like super cheap ways. And for them, maybe it won't shift down so much, but it's okay because it's not violating arbitrage, because whatever they're manufacturing probably isn't a market item. So it's not like it's connected to all the stuff in the market. Like, in fact, they're trying to produce it cheap so that they can end up with a profit. So just keep that in mind, that sometimes it's like that. Okay. But the big thing is here, it looks like that. Now this thing is called a floor. And it makes sense because you're always guaranteed a certain amount, but maybe some more, right? So there's like a lower bound on how much you'll get for something. Now this is just payoff, it's not profit, so it's a little different, but so it's not the complete picture, but that's okay. But it's called a floor. Now with this one here, okay, starts at 0, so the combination starts at 0, and then I've got a +1 slope, 0 slope is going to be a +1 slope, and then +1 slope, -1 slope is a 0 slope. So this is what the payoff here looks like. It kind of looks like a, what is that, a short put? So that's okay, kind of similar to a short put. And if it's actually all market items, it would be, the profit would be exactly the profit of a short put. So that's kind of nice to know. But this thing here, anytime you use a short something to combine with a, to hedge, they're going to call it a covered call. And we're going to see with a short asset, it's going to be real similar. We just know that we start with a short asset. And now we can use anything. So that is a negative slope. So we're going to want things with a positive slope. So we'll go long here and short here. So I've got -S plus a call. And let's see what this payoff looks like. Well, it starts at 0, starts at 0. So starts at 0. -1 slope, 0 slope. So it's got a -1 slope. And then -1 slope, +1 slope flattens it out. And this one kind of looks like a floor also, right? There's this bottom limit, but this one's called a cap. That might seem a little bit weird why that's called a cap, but it makes perfect sense, because if you're short in the asset, that means you're going to have to pay it back later. So here, if I combine it with this call, that's going to kind of like put a highest amount that I'm going to have to pay back later, right? I'm going to have to pay back no more than where that sort of flattens out. So that's why it's called a cap, because you definitely have to pay back. You just don't have to pay back infinite amount. It'll just stop here. Okay. And then, all right, this next one, this last one's kind of weird looking, but all right, starts here, 0, -K. So we're going to start at -K. And then I've got, okay, a negative slope, positive slope. So it's going to be a 0 slope. And then minus slope, 0 slope is minus. But again, this doesn't really feel too good there, but that's okay. It's a minus stock, minus a put. And then this would, because I'm hedging it with a short something, we just call it a covered put. Okay, that's okay. And you can use other combinations of stuff, and you got to see what your combinations get. Okay. All right, so let's kind of use this here. And there's one important kind of almost deceptive thing that they do on a question that I just wanted to alert you to. Okay. So, but kind of like for hedging, really honestly, it's all just sort of a graphing thing. So you can actually be equipped to do these really well. So, okay, so Shelly produces palladium and will have 200 grams in a year to sell. So she'll like to guarantee that she'll receive at least $15 per gram. So she purchases appropriate options for $1 per gram. And then each gram costs $5 to produce. Okay, so it's kind of a lot there. But basically they said here, if the effective risk-free rate's this, determine the prices for which the hedged combination is better than the unhedged. All right, well, let's go back to paragraph 1 now. And one deceptive thing they do, actually there's two things that they're not real clear about, but one thing is that, she wants to sell it. So I don't know about you, but immediately my mind goes to short. She's short in this. But actually she's long in it, because usually when we say like, oh, she's going to sell for shorting, that's kind of like what you do at time 0. But what she's doing is she's producing this, and then in the future, she's going to sell it. So she actually owns it. So she's really long in it. So the unhedged is really just this, where she's just long in the asset. And that's going to be her payoff. Unhedged. So the portfolio is just plus the palladium or whatever. That's it. And then the other thing that's a little bit deceptive is, well, if we wanted to shift, we know we're going to shift it down. Here, though, it's actually the arbitrage rules don't apply because palladium is not a market item. It's not like a call and a put on a share of stock. It's like they're producing it. So we could have the things that violate the arbitrage, but she is going to have to like pay for it. So it is going to, it's going to cost money. And they said it costs $5 to produce. Now, the thing that they're not real clear about is that already is actually the future value of the cost. And I guess that makes sense because you're not like paying for it at time zero and then you're kind of like using all the stuff. Usually you pay the bills at the end. So it already is the $5 is the future value of the cost. So that's actually nicer because now we don't have to use the interest rate to accumulate that. We actually know that the profit is actually shifted down by exactly $5. Okay, so that's cool. Yeah, the payoff, blue curve, minus future value of the cost. Future value of the cost is 5, so we just shift it down by 5. Now that's going to actually help us with the hedged position, because the hedged position, we know they're long in the asset. And then they said here that they'd like to guarantee that she'll receive at least $15 per gram. So we think of, all right, we're going to have to add some graph to this that has a, well, this is a positive slope, so we're going to need something with a negative slope to kind of be compatible to add. And we think back to these and we're like, well, which one of those will guarantee a specific price? And we're like, oh, that's exactly what the floor is. The floor is where I'm going to always have at least a certain amount of money and then maybe more, depending on kind of how good it does. So I realize that what they're describing here is a floor and a 15 strike floor. So I realize that I'm going to need to, the option that they're talking about is a put with strike 15. So even though they didn't say that you want a floor, the situation they're describing is exactly that. And when we do this, we're like, oh, okay, now I can graph these. Actually, we can be pretty fast about that. We know that, yeah, we're going to start up at a 15. We're going to go over and up. And then I just want to talk about, or we just want to know about the profit. And so the profit, we know we can kind of like combine the costs of the other things and the future values of the cost. So this one, future value of cost, was already 5. We knew that. And here the future value of the cost is, well, okay, they said that each one of those, each of those options costs $1 per option. So we know that each of them costs, so this is a legitimate one. It costs at time 0 to do that. So it's going to be 1, but then plus interest. And so since it's a year and the effective rate of interest is 5%, I guess we're just multiplying by 1.05. So I guess here the total combined cost, future value of the cost is 6.05. So that's good because then that tells me I'm going to take my payoff minus minus future value of the cost minus 6.05. So notice here that the profit is completely above the axis, but again, that's okay when it comes to these hedging ones where they're not all market items. It's okay. But I know kind of geometrically it's going to shift down by 6.05. So 15 minus that is 895. Okay. All right. So that's good. So that's half the battle. Now, one last thing here that we've got to do. that. Sorry. Okay. Apologize about that. I don't know what's going on there. Okay, well, one thing here now, what we want to do is we want to find out how does the hedged combination outperform the unhedged. So for that, what we're going to do is we're going to look at the two red graphs here. And I know one of them is the -5, right? That's the one that starts there. And then the other one is the one that goes 895. And presumably it's going to do this kind of thing where we're just going to be looking like that. And so if I compare these two, we see here. Now, if they don't intersect, we're going to find that out pretty quick. But okay, let's see what happens. So basically, I want to know the hedged combination. That's this curve. So that's going to be, where does that do better than the unhedged? And I guess that's this area over here, isn't it? So here's what I'm going to do. We're going to actually call this X. And I'm going to try to find out where are these two things intersecting. So it's really easy with the geometry here because I really want to know, well, this one here is 895. So that's 895. But then this one is a line with slope 1 and an intercept of a -5, isn't it? So I actually know that that's just going to be X minus 5. And so that point that they intersect, just add the 5 to the other side, X equals 1395. And that's the point where they intersect. So that's perfect because now I can say that the hedged is going to outperform the unhedged as long as the price is below 1395. So I would want the price in the end to be less than 1395 to be able to do that. Okay. So that would be my answer right there. That's what I would need to have happen. All right. So I hope that kind of helps with some of these. And tomorrow the seminar will be a little bit shorter. Sorry, this first one's always a little bit long, but talked about a lot of good things here, and I hope you found it beneficial. Thanks for joining. If you have any questions, I'll stick around for a few minutes. Otherwise, feel free to get back to whatever you're going to be doing this Saturday, and I'll see you guys on tomorrow. Got a lot of good stuff to talk about. So thanks so much, and have a great one.